Alan, good morning. Are we having 6 members in the platform?
Good morning, sir. Yes, we do have a quorum.
Okay.
Recording in progress.
Okay. Let's start with our meeting. The agenda is a bit long. We'll try as much as we can to make sure that we finish in time. Be that as it may, everybody will be given an opportunity to present his or her case. The meeting is officially open, and welcome everybody, members of the committee, stakeholders, support teams, media, everybody in attendance. The purpose of today's meeting is to receive responses from National Treasury and SARS on the monetary amounts and amendments of revenue laws bill, TALAB, and TLAB. So there we are. That's the purpose of today's meeting. Do we have apologies?
There are no apologies, sir.
Okay. There are no apologies. National Treasury and SARS, are you ready?
Yes, good morning, Honourable Chair. We are ready.
Okay. Honourable Squad, are you there?
Yes, sir.
Please assist me to chair the meeting. I'm attending to something here in Parliament, Office of the Speaker and Chairperson of Chapter. So take over. But I will remain in the platform. I'm not going out. I will also be listening.
Okay. All right. Thanks, sir. Good morning, colleagues, and we are going to then allow the first presentation in terms of responses to make sure that we are able to at least keep up with time, as the chairperson has already alluded that we need to finish our meeting on time so that we're able to be ready for the sitting as well. So thank you, Chair, and can we then start?
Thank you, Honourable Chair. Good morning, Honourable Members. I'm happy to start. My colleague Umpo will share the presentation. I'll provide a quick introduction. So today we're dealing with 3 bills. It's the Rates and Monetary Amounts and Amendment to Revenue Laws Bill that was introduced on the 24th of April. It's also including comments and responses on the Draft Taxation Laws Amendment Bill, which we call the TLAB, and the Draft Tax Administration Laws Amendment Bill, which we call the TALAB. Those were published on the Treasury and SARS websites on the 16th of August, and they had a closing date of 12th of September for comments to be provided by the public. Treasury and SARS, we briefed the committee on these bills on the 17th of September, where we ran through the proposals that they were included there. These generally contain the more complex measures that were announced in the budget by the Minister of Finance. The previous bill, the draft or the Rates and Monetary Amounts and Amendment to Revenue Laws Bill, which we call the Rates Bill, that included a lot of the rate changes and threshold changes that were announced in the budget. But the TLAB and the TALAB include the more complex measures, which contain quite a lot of legislative drafting, and we do need comments from the public to make sure that it's in line with what our policy intent is, as well as getting their views on the amendments that we are making. We did hold workshops with those taxpayers on the 22nd and the 23rd of September. So we listened to the comments, we had discussions on the clauses in the bill. In terms of the comments, there were 65 different organizations that commented on the bill, and 6 individuals that commented on the 2 bills. The committee then held the public hearings on the 21st and the 22nd of October. And today we'll take you through our initial draft responses to the comments that we received on those bills, both directly to us and those that were raised in the public hearings. These are draft comments. And after discussions with the members today, we can formalize the approval of the bills to prepare them to be tabled in the MTBPS. So these are National Treasury's draft views, and we can formally adopt them once they are then tabled in the MTBPS. But we do need to have these discussions first. Umpo, if you just go through the couple of the first slides, it just deals with a couple of what was included. As I said, the rates bill has those issues in there. It has the monetary thresholds, an extension date, excise duties, an employment tax incentive adjustment, carbon tax cost recovery adjustment, and the cancellation of that increase for the health promotion levy. If you carry on. The TLAB, which I spoke about, has issues related to all of those sectors there, which we will get into quite a bit of detail, but we will try to be quick. And then if you look at the TALAB, it looks at those 4 different acts and trying to make adjustments there. TALAB includes a lot of the administrative sections that are run by SARS. So we can start with the rates bill, and Umpo, can you go ahead to go through both the amendments that were announced and our initial draft responses. We will then shift through the different teams, Chair, for each individual that is responsible for their different sections as we go through the presentation. Thank you.
Thank you.
Okay. Thank you very much, Chris. Good morning, Chair, and good morning, honorable members. Can you hear me?
Yes, we can.
Okay, no, thank you very much. I'll be taking you through the comments that we have received with regards to the rates bill. In the rates bill, we proposed an increase to the excise duties on alcoholic beverages and tobacco products, and also on vaping, ranging from 4.75% to 6.75%. And then we also had a proposal around the ad valorem excise duties on smartphones to introduce a duty-free cap of 2,500, that those cell phones become ad valorem excise duty-free. And then also we introduce or propose the cancellation of the proposed inflationary increase to the health promotion levy. And also the rates bill proposed extension of the urban development zone tax incentives up until the 31st of March 2030. And then also some adjustments that were made to the employment tax incentive. And also there was an increase to the carbon tax cost recovery of 99 cents per litre. In terms of the comments that we have received on tobacco products, these are the general comments. I think some of the details are included in the response document. But in terms of the general comments that we have received, was that the increase on tobacco products has placed the excise duty incidence for cigarette above the 40% incidence, and then also that there should be a freeze on the excise duty increases because of the problems that we're experiencing with regards to illicit trade. But also, I think there was a call for Treasury just to be cautious around the increases on excise duties, given the financial pressures that consumers face, and also that the legal cigarette market becomes less affordable. Therefore, consumers then will turn to the illicit market. And I think with regards to the draft response or the preliminary response to those issues is that the increases that we have made specifically for cigarettes and cigarette tobacco for the past 3 years has just been inflationary adjustment, and that takes into consideration the issues around illicit trade that is most prevalent in terms of tobacco products, specifically on cigarettes. So the inflationary adjustment takes into consideration those dynamics in the sector. And in last year's comments and public participation process, which was the second year of having an inflationary adjustment on the excise duty for tobacco products, that was welcomed by the industry. And basically this year we're just continuing with just an inflationary adjustment on tobacco product excise duties. And then also that also takes into consideration some of the dynamics around the impact of the COVID-19 measures and the impact that it has had on the revenue since then, that the revenue for tobacco products hasn't recovered to pre-COVID levels, and therefore the inflationary adjustment takes into consideration all of that. And then when you look at the issue around alcohol, also there was concern that beer excise as a percentage of weighted average retail price has increased quite substantially from 2020 to 2025, exceeding the guideline of 23% for beer. And also that the comment was that it demonstrates that the excise has outpaced both inflation and the retail price growth, creating a compounded burden on consumers. And the request that the stakeholders were making was that for 2026-27, the excise duties be capped at the projected CPI, and the figure was given there around 4.3%, that we should keep it at 4.3% in the next budget, and also that we implement an automatic CPI indexation from 2027 to 2028 onwards. And then this, in the views of the industry, is that this will create a predictable, fair, and investment-friendly tax regime. And then also, some requested that Treasury should consider making no further excise duty adjustment to the spirits specifically, to support some of the efforts that have been done by the industry and government to deal with illicit trade, specifically in terms of the spirit market, but also to look at how we do excise duty adjustment, that it requires sort of like a nuanced approach, because just raising excise duties does not address some of the underlying drivers around harmful alcohol consumption, that we should take a nuanced approach around these excise duty increases. And our response to those issues that have been raised is that whenever we make the budget proposals, the tax policy basically entails sort of balancing the trade-offs around the revenue raising requirements for the budget, but also doing it in an equitable and efficient and sustainable manner, and also to achieve some of the government development objectives. And also sort of like responding then to those things then requires that one should look at the long-term tax policy context and the role of tax policy in the overall fiscal strategy. Because I think maybe just here, Chair, I might just highlight that all the tax instruments that are there in the system are there at the disposal of the minister in terms of looking at what the fiscal requirements are. So there cannot be situations where some other taxes are not available to the minister to be able to meet his obligation around the fiscal framework and the fiscal requirements. Therefore, the excise duty increases in our case, we view that we have been increasing excise duties over the years, and the comment to say that the excise duties have outpaced the growth in the retail prices just indicates that the industry is not passing through the excise duty adjustments. Therefore, the prices don't keep up with what the excise duty increases are, and therefore the incidence of the tax will be much higher because the retail prices do not reflect what the excise duty adjustments are. And we do acknowledge that Chair, that raising alcohol excise taxes may reduce general consumption at a population level, and provided that there is an increase in the general prices, but also that this excise duty increases, they require non-tax measures to be able to address the issues that have been raised around National Treasury looking at a nuanced approach to say that for those that are abusing alcohol, there needs to be other measures that complement the excise duty adjustment that we are making at the population level. And when it comes to the issue of illicit trade, Chair, which I think it is quite prominent for both tobacco and alcohol in terms of the comments that we have received, is that for tobacco specifically, the illicit trade has grown substantially over the years, and especially since COVID. That some of the studies they show that it has reached about 74.5% of the cigarette market, and also that if we keep on increasing excise duties and there is low enforcement levels, basically the tobacco industry the legal tobacco industry will disappear, and then what will remain will just be the illicit market, and also that the increase in illicit trade basically then defeats the government objectives around reducing harm from consumption of these products, because consumers have access to illegal products in the market. Therefore, the public health objective is defeated in that case, and therefore the stakeholders have requested National Treasury just to appreciate the effects that illicit trade has with regards to the legal tobacco industry when making such adjustments. And furthermore, there were comments around that SARS should deploy additional resources that have been allocated this year to focus on illicit trade, and that there are illicit factories in South Africa that SARS should focus on. And some of the suggestions that have been put forward was that maybe SARS should then consider putting customs officers in some of these factories to be able to monitor production and in compliance with the excise duty requirements. And that National Treasury should also closely monitor the additional funding that has been given to SARS to make sure that those amounts are allocated towards enforcement, and so that we can recover the revenue that is due. And then also that SARS should implement a track and trace system that for the cigarette and vaping products, so that it can help in terms of the enforcement and also monitoring of the supply chains, in the tobacco industry. And also another suggestion that we provided was that we should introduce a minimum retail price of about 37 rands per pack of 20 cigarettes to achieve an effective enforcement and address retail tax compliance. And also looking at the illicit trade specifically for alcohol, the general comments that we have received was that there's a large and growing market for illicit alcohol, which provides for more affordable alternatives. And therefore, if we keep on increasing the excise, the legal alcohol becomes unaffordable, and therefore this illicit alcohol becomes very problematic, especially for vulnerable communities. And also that there's a specific issue around the price gap between low-priced wine and the sugar-fermented ales, and the figure has been provided that the current price gap is about 62% and pose a risk, particularly for consumers of low-end alcohol. And then also that the illicit trade is costing the country an estimated 16.5 billion in lost revenue for 2024, which is, if you look at what we have proposed this year in terms of the increases and what the revenue, the additional revenue we are expecting from the adjustments that we have made, that what we are losing is basically 13 times what we are proposing to raise in this current financial year from the excise duty increases. And therefore, these increases basically are growing much faster than the incomes, and therefore it promotes illicit and then black market because of affordability of those products. And in terms of our preliminary responses, that National Treasury, we have acknowledged that the problem of illicit trade for both alcohol and tobacco products, that is a concern for us from both the health perspective in terms of our public objectives around the implementation of excise duties, but also from a revenue perspective that we are losing revenue, and we have seen that in the tobacco space that we have not recovered revenue to the pre-COVID levels, and that is a concern for us, and hence the adjustments that we have made on tobacco products have just been limited to inflationary adjustment, because it takes into consideration some of the issues that are mostly pronounced in the tobacco space with regards to illicit trade, and in SARS also in terms of the some of the measures that have been implementing with regards to compliance. And also the additional revenue that has been referred to, the minister made additional budget allocations to SARS this financial year to also rebuild enforcement capacity and improve tax compliance. And we're hopeful that through the implementation of those measures by SARS, a lot of revenue will be recovered from those efforts. And then also we had made previously in last year's budget, Chair, that we've made a commitment to the committee that we'll be engaging with the SARS with regards to the additional funding that has been allocated to them to ensure that the funding is effectively directed towards strengthening compliance and revenue collection. And I think one of the measures that have been implemented is this monthly reporting around some of the revenue recoveries that SARS is doing. And with regards to the proposal on minimum unit price, Chair, I think in principle, it is something that we'll consider and also look at the feasibility of implementing that, because what the minimum unit price or minimum retail price will do is that will reduce the affordability of these illegal products that you don't find a pack of 20 selling for 5 rands. So I think we will consider that and look at the mechanisms around how that can be implemented. I think that will help in terms of reducing consumption of this product and making them a little bit less affordable. But again, in terms of the legal industry, I think it will provide them kind of like a platform for competition with regards to these other cheaper products. And there were other related issues that were raised with regards to the proposals that we have made in the budget. We had proposed that normally the excise duties become effective on budget day in February, and we had proposed that we should be looking at implementation of this excise duty adjustment from the 1st of April, and the comments that we have received was that, especially from the tobacco industry, that even the anti-forestalling rules, the 1st of April might not necessarily sort of like work, and it will require some of adjustments to be able to work effectively for the tobacco industry specifically. And we'll be working with SARS with regards to their chair to make sure that any consequential amendments that need to be made around some of these anti-forestalling measures, they are implemented so that we provide that administrative ease that we wanted to achieve through this effective date of 1st of April rather than on budget day. We'll make sure that the date is ironed out. And then also there was an issue that was raised around the alcohol tax review that we published last year, that stakeholders have sent National Treasury comments on that alcohol tax review, and therefore we have not had any engagements around how we are taking that forward. And how that is going to be impacting the budget next year, since we have not had any engagements with regards to the reforms to the alcohol tax policy. And our response is that we will be starting, Chair, given what that has happened this year, we have not had an opportunity to have a stakeholder consultation, but we will be starting with the stakeholder consultations from this week, and then there will be a number of follow-ups in terms of the workshops that we'll be having with the stakeholders to deal with the specific aspects of the reform that we are thinking about. And we have always communicated to the taxpayers that any reform that we are embarking on will be consulted upon before it's implemented. So I think there should not be any worries about this reform in terms of the budget next year, because we are just starting with the consultation process. Thank you very much, Chair.
Thank you. Is there any additions?
Yes, we have. Sorry, Chair, we have got quite a few. Zalasile will start with the next section.
Okay.
Zalasile, are you there? Yeah,
yes, I'm here, Chris. Thanks so much, Chris. Honorable Chair, honorable members of Parliament and this committee, good morning. I'll be dealing with the personal income tax section of our presentation. And the first issue is with regards with the reducing of the threshold for ring fencing of assessed losses. And I'll be dealing with that. Chris will be dealing with the second issue regarding the cross-border tax treatment of foreign retirement benefits. Chair, honorable members, you will notice that the comments on this particular proposal carry or they drive a particular theme. That government introduced this proposal to stifle growth of middle-income earners and curtail savings. Chair, honorable members, this narrative is not aligned to policy objective of government. Hence, the stakeholder comments on this particular proposal have not been accepted. The aim of government, Chair, honorable members, is to treat taxpayers equitably, ensuring that no one is unfairly burdened with tax liabilities or given undue preference. For example, in this particular proposal, you have taxpayers who are making use of losses from one trade and to reduce income from another trade, which is not the intention of government, particularly on this issue. Chair, honorable members, we are talking about hobby-like trades, the so-called suspect trades which are listed in the Act. You will have a taxpayer, for example, who utilizes losses from the buying and selling of cryptocurrency assets to substantially reduce their taxable salary income. This is not the intention of government. The second slide. Thank you. So, Chair, honorable members, to ensure that we do not unfairly treat genuine businesses or penalize them unfairly by introducing this proposal, there are existing safeguards that remain in the Act, Chair. And taxpayers are still have the ability to offset losses against future income. But these losses should be aligned to the trade where the particular taxpayer is generating or receiving such future income. So hence we are reducing now the threshold for ring-fencing of assessed losses from 45% to 39% marginal tax rate, so that we are able to curtail, Chair, these kind of aggressive tax planning exercises, particularly on this issue. Over to you, Chris.
Thanks, Balatile. So I'll go through the cross-border issue, and maybe I can do so just by explaining what we were trying to do and why. So at the moment in our current legislation, there's this exemption for pensions that you receive from a source outside of South Africa if it was due to past employment out of the country. It was introduced in 2001 when we moved to a residence-based system of taxation. But at the time, it was stated as an interim measure, and it needed to be reviewed within 3 years. And basically what it means is that if you receive your pension from a source outside the country, you won't get any tax within South Africa. It's tax-free. Now, the exemption is still in place. It's got quite a lot of interlinkages with the double tax agreements, but there are a number of drawbacks. And this is why we tried to put this amendment in this year. For one, if you exempt that foreign pension, you're giving up your taxing rights on these amounts. And even if we've done an agreement with another country through a double tax agreement, where the other country says, yes, you have the taxing right, by putting this exemption in our domestic legislation, we're giving up that taxing right. So if, for example, you look at a couple of double tax agreements, say with Germany or France, if a person comes to retire in South Africa from France or Germany, because of this exemption in the domestic law, we won't tax that income. But they are not getting tax-free income. According to the DTA, they will still be taxed within Germany or within France. So they are still taxed, but not by us. But if a South African then goes to Germany or goes to France and retires there, according to the double tax agreement, they will be taxed by Germany or by France in that country. So we lose the taxing right for our South Africans who go there. But if a German or French person were to come to South Africa, we also lose it through this domestic exemption, and it's taxed within Germany or France. Now, if we were to remove the exemption, in effect, we would then reinforce our own taxing rate. We could start to tax those amounts. According to the DTA, Germany or France would then not be allowed to tax those amounts. So for the individual, there shouldn't be that much of a change. It'll just shift the taxing rights from who pays There will be a change according to where they are on the personal income tax table and whether our personal income tax tables are different. But it'll shift the amount of tax that's paid that goes to Germany. It'll now come to South Africa. So South Africa then gain revenue by enforcing that taxing right. If the tax that they were to pay in the other country is actually higher, that person might even get a lower amount of tax that they pay according to our personal income tax tables, so an increase in disposable income. So in effect, you could get a situation where SARS gets additional revenue and the person who has retired here also gets additional revenue through higher disposable income if the tax is lower. But that's depending on the tax tables. We do have quite a strict personal income tax regime. So for other countries, they might actually be paying a bit more. But you can see why it would then almost be a win-win from our perspective in terms of getting rid of this exemption. So that's for some countries according to their DTAs. For other countries, according to their double tax agreements, the taxing right stays within the source country. So if we were to remove this exemption, which we proposed, there would be no change, because even though we've removed this exemption, we can't enforce the taxing right. So countries like Ireland, Nigeria, Mauritius, Zimbabwe, Seychelles, and we must just check, this is just a general viewpoint. But those countries, the taxing right will still be in the other countries. So by removing this, there's no change to those retirees. A problem does come up with the third scenario. So the third scenario is there are countries with double tax agreements, but the country in the double tax agreement is defined as the one that only has the taxing rights. So for example, like in the UK double tax agreement, it says that only South Africa has the taxing right for someone who comes to retire here. Now, by giving this exemption, that means they're not taxed here, but they're also not taxed in their source country. So they would have received tax deductions on their contributions, tax-free growth in their fund, and then if they come and retire in South Africa, they can get tax-free income. They wouldn't have paid tax at any point. And this is what we call double non-taxation, where there's no tax anywhere. And this isn't a situation we want to permit and allow to continue. However, it will have a very big impact on those individuals if you do remove the exemption. So that's from a government point of view, we're trying to get rid of these instances where there's double non-taxation and they're using these double tax agreements to in effect avoid paying tax anywhere. And we also are trying to enforce our taxing rights. So if I go into the comments of what we've received, quite a few comments said, stay on the previous one, sorry, Umpo. Quite a few comments said, this is going to actually reduce our appeal as a retirement destination and is seen as an incentive for retirees to come and settle in South Africa. But as I've said with those few examples, from some countries, they're getting taxed in their home country, their previous country anyway. For other countries, they will continue to only get taxed in their previous country because it's based on source. So in effect, this is only an incentive for a handful of countries where there is this double non-taxation that comes into effect. So it's not a general incentive for foreign retirees. There is also a comment that if we repeal it, it could result in double taxation of foreign retirement benefits. So contributions to foreign funds that actually didn't get a tax deduction, but now we tax it again by withdrawing this exemption, and in effect, they'll be taxed twice. And then if we go to the next comment, and because of this, there are quite a few proposals that were made to say, A, you need to fix the double taxation, so make sure that double taxation doesn't occur. And B, what about the impact on these people who are not paying tax? They are now retired, so they don't have the ability to start work again, to get another job. They have based their retirement on the level of income that they've got on the current situation. This exemption has been in place since 2001, so they're saying that this is not a temporary exemption. How can they adjust their circumstances? So their proposals to say, why can't you put in, for example, a partial exemption, or the first 1.25 million is tax-free, and what else can you do? So in terms of what we would like to do, I've spoken how we would like to try and fix this issue. The problem at the moment is that the current legislation doesn't quite get us there because of these issues. So we are proposing that the amendment is withdrawn for the moment. And we need to look at two things to try and adjust it in the future. The one is to make sure that double taxation doesn't occur, so that we don't start taxing foreign pension funds where a deduction was not provided on the contribution. And the other issue that we need to be quite careful of is the impact on some of these countries where they will go from a 0 rate of tax to a full rate of tax in 1 year. And we need to look at mechanisms to try and either soften or phase in that amount. So our proposal is to withdraw it. We need to try and find this balance. We do want to protect our taxing rights. We do want to prevent double non-taxation. But we are going to have to go away and consult a bit more and come up with a couple of different measures to make this watertight. It is a big change, and we did put it in at the beginning of the year, and it was a big change, and we knew we would get quite a lot of pushback on it. And this isn't us saying that this is not going to come back, but we do need to work on a couple of further amendments. That's it from my side. I think we're now going to move to Anu on some of the anti-avoidance mechanisms. Thanks.
Good morning, honourable members and stakeholders in the meeting. The first issue that we are dealing with is extending the anti-avoidance rules, dealing with the third-party backed shares. At issue, next slide, please, Paul. At issue here, just the background behind it is our proposed amendment is aimed at strengthening the anti-avoidance measure by essentially neutralizing the avoidance through a dispensable enforcement right, i.e. the ability to switch that enforcement right on and off strategically at certain points of your assessment, and through that avoid the payment of dividends tax. So what we are proposing is tightening our anti-avoidance measure by essentially having a once applied, always applied rule. Next slide. So the comment was that there are a perceived problem with the once applied, always applied rule, because there might be instances where these enforcement rights are waived for various other reasons other than trying to obtain a tax benefit. Our response to that is it's not accepted. The problem is we are trying to create a consistent treatment and close a very clear loophole that's easily obtained, where through temporary facts and circumstances, taxpayer would be able to structure things in a certain way that they get the benefit of a tax benefit through a very simple process. And we are now limiting it through the proposed change and looking at the economic substance of the actual transaction so that you can pierce it to see that it is mischievous. Next slide. This one was proposed amendment in the 2025 draft TLAB that we first published, but the Minister of Finance on the 3rd of September 2025 retracted the proposed change to the definition of hybrid equity instrument after concerns were raised about the potential impact on the preference share financing and investment by industry. It was confirmed in our withdrawal notice that any future proposal on this matter would follow a consultative process so that we can ensure a balanced approach between addressing both the stakeholder and government concerns. Next slide. With this one, I'm handing over to Nhlanhla Gedebe.
Okay, good morning, Chair and honorable members. I'm going to also try and move faster on this one. The key issue here was more about the trend that was actually being seen, where some of the portfolios were actually transferred into CIS vehicles, and then primarily for the benefit of a CGT relief. So one of the key issues, the proposed amendment then, we're trying to switch off those corporate rollover reliefs in section 42 and 44. However, one of the comments that came in was to say, look, there are some of those legitimate commercial reasons for asset for share transaction, which falls within section 42. And then, of course, then there was also another issue with the amalgamation that are actually done because of regulatory purposes. Next slide, Mpo. So based on that, and then based on some of the comments that came, we then opted to withdraw the amendment that were going to be done under section 44, taking into account that these regulatory changes that are done by the CIS are also done because of CISCA, that's section 99 of the CISCA Act. So we then pull back on that one. However, on section 42, we'll go ahead in order to try and prevent the misuse of section 42 rollover relief in cases where the individual then investors initiate this asset for share transaction. That is that one. And then the next comment again that came in was to say, look, to the extent that you are switching off the corporate rollover relief, then the tax that will be triggered now will be the STT. So on that one, we then also proposing to make some amendment on the STT Act. Next slide, Mpo. So what we're suggesting as well is to say, look, we will make an amendment on the STT Act to cater for this issue, and the entire amendments in 42 and also on the STT will now be delayed until 1 Jan 2027. Also, just to make sure that we also have some time next year to engage, because one of the issues that came was that from the taxpayers was to say it's not necessarily every CIS. However, it's those closely held funds that abuse the system. So we may have to then go back and try and see if we can craft some sort of a definition to separate a normal CIS and those ones that are actually abused this exemption. Thanks, and Paul. Next slide. And then there was the next one with respect to section 23M. Okay, my colleague Haley is not here, but the key issues here, we made some amendment.
Haley is available.
Oh, Isabel. Oh, okay. Yeah. No, thank you. So apologies there. Okay.
Hi, and thank you, Nhlanhla. Good morning, Chair, honourable members, and everyone else on the call. So here, just to give a brief background and speak about it from a high-level perspective, because we have detail in the Word document. But you'll recall that a few years ago, we strengthened the interest limitation rules because they were being circumvented in some instances. And one of the ways that we sought to do this was to expand the definition of interest so that taxpayers could not disguise other forms of payments to get around the rules. And this was done as well in conjunction with the the decrease in the corporate tax rate. And this was to provide some of the funding for that decrease. So in the 2024 Annex C process, we received a number of comments from taxpayers that the outcome of those changes had made it quite complex. So while the rules apply to taxpayers where there's a controlling relationship and where the interest income on the other side is not taxed in full, they were having to make adjustments for example, Forex differences, even if it was in respect of a loan with a third party, for getting to the adjusted taxable income amount, which helps in determining how much interest they can deduct. So the adjustments this year were really in response to those requests. We recognize now that we sit with two definitions of interest in section 23M, which is something that taxpayers were concerned about. So it's been difficult to retain the policy intent and move away from that. However, we have We have accepted some of the taxpayers' comments so that the limitation will include, the calculation of adjusted taxable income will include those amounts that are up for limitation. And we will also include an example in the final explanatory memorandum with the aim of enhancing certainty for taxpayers. So it is Treasury's intent that these rules are clear and certain so that all taxpayers have the same understanding. And we hope that we have achieved that with these adjustments. Thanks very much. You can move to the next.
Hello, are we still having any additional presentation?
Yes, sorry, Chair, there's still quite a few.
Okay.
We'll try and be quick.
Yeah. Okay, no, thanks, Chair. Thanks, Chris. Okay, the next one was more about there's this issue within the Income Tax Act where there's no clear guidance on how to treat the capital distribution. So basically, we then implemented some rule there. One of the comment that came was to say we must align the wording with that one of paragraph 76B. So to that extent, we accepted that we'll make a change. Next slide, Mpho. Okay, this one was more about the comment that came on the component manufacturers who actually were asking for the incentive at 150% deduction to be given to them. Next slide, Mpho. And the main issue there, we said, look, the key issue, the tax incentive was not extended as they will receive a higher cash grant of 35% as well from this automotive investment scheme. Next slide, Mpho. Okay, I'll just touch on the three key issues on the international tax. Next slide, Mpho. The key one is mainly about the interpretation issue. It was one of the comments that came up to say maybe we have to look into section 9H4 and 9H6 to provide the exit charge such that the exit charge triggered in section 9H3 will not apply. We noted the comment and we're saying this is an interpretation issue. We don't see an issue, we're saying, because section 9H3 will not be applicable if those sections apply. Next one, Mpho. There was, we made some amendment in section 7 and section 25B on the trust issue. So the comment that came was to say the deletion maybe to the provisions of section 7 from section 25B of the Act are unclear. And then there was a request to confirm that this removing this phrase will not alter the current interaction between section 7 and section 25B. We accepted the comments. Changes will be made to section 25B on the trust fund. Next one. The key one, these ones are exchange differences rules. Basically, I'll just sum up all of these comments. The key issue was that the comment was saying there is some sort of inconsistencies and they cannot actually follow through on the wording, and we then accepted all of the changes and then we will reword this section. Next slide, Mpho. Okay, on the global minimum tax, there was a comment that came to say that we should take into account the globe model rules that were released before the start of the fiscal year. And so that comment as well was accepted on that front. Next slide, Mpho. Oh, it's a value-added tax. Thanks, Chris. I will hand over to Anissa.
Good morning, everyone. Thank you so much. Can you? Yes, thank you. Okay, so one of the amendments that we're proposing from a VAT point of view is as a result of a court case, Capitec Bank versus SARS. And in that instance, the insurance premium was not payable by the person who took the loan. So there was a lot of confusion and on this in practice to say, and even in the court cases, there were 3 courts that it went through. And so the proposal here was if we had introduced the word premium, or at least we introduce it within the definition of insurance to say a premium must be paid, it will clarify a lot of that. So we did that, and then the comment was that the word premium itself was not defined in the VAT Act. And So we accepted that, and we will be defining the word premium. We go next one. Okay, the next one was on educational services. Now, a lot of educational institutions, bodies that represent schools, approached SARS and Treasury to say that there is a lot of difficulty when it comes to education institutions needing to register for VAT. The basic education, now they don't have the financial or the admin capabilities to comply with the VAT Act, but it also requires then, getting outside assistance into like consultants, and that becomes a bit of costly. So what happens is schools have, we know education is exempt, but they also make other supplies to external third parties, and generally it's things like hiring out the hall, hiring out a ground, a pool, things like that. And that sort of income becomes taxable. Now what happens is then the schools is now making a mix of exempt and taxable income, and would have to then do apportionment calculations, and that becomes quite complicated. Now, when we proposed the amendment, the comment was that they need more time to accurately assess the impact. What that relates to is when any VAT vendor has to exit the VAT system, there's a deeming provision in the VAT Act that says that on any of your retained assets, wherever you've claimed input tax on this, you will have to declare an output tax on that amount. Now, that's the difficulty that they are complaining about, and says that, look, we haven't budgeted for this. This year's budget has already been done. Even though you're implementing this from the 1st of January, we haven't budgeted for it. Next slide. We've partially accepted that. So what we've decided to do is that although the amendment will come into effect on the 1st of January, that exit VAT that they have to pay, that liability, will only make it payable a year later. So from the 1st of January 2027. So they have next whole year to budget for this. But at the same time, we've put in a provision that this can be payable in installments, either 12 monthly installments or any other period that you can arrange with SARS. So that would ease the impact on this. The other comment was that we must consider the impact this amendment would have on welfare activities, because some schools conduct welfare activities as well. We've accepted that, and what we are saying is that we will then exclude welfare activities. However, such schools need to apply to SARS for ruling in this regard. Next slide. Now, one of the difficulties that they spoke about was the cost factor and the problems relating to cost to schools, increased cost to parents in terms of school fees. So we put in an example here that just explains why that concept is a bit misconstrued about the cost. So if you look at, for example, school bills, an aquatic center or a major pool for 30 million rand, and you work out the VAT on that being 4.5 million rand. So on average, from what SARS has seen from VAT returns of schools, the average apportionment ratio is around 2%. In other words, the bulk of what they're doing, the bulk of their income is exempt, and just about 2% only is taxable in terms of what they do, which makes sense. So if you look at that VAT that they would have paid of 4.5 billion, and they deducted that 2% of that, which is 90,000, that would now be the extent of their liability when this kicks in. But it will be only effective from the 1st of January 2027, where they have to now make arrangements with SARS to pay that 90,000 over the period of time. So it's not as, unfortunately, what SARS has seen is that some schools have not really applied the proper apportionment ratio that the Act talks about, which is the turnover-based method. The default in the Act is the turnover-based method. If you want to apply anything else, you must apply for a ruling to SARS. And without such a ruling, it becomes an apportionment method which is not strictly legal. And so in doing that, some have claimed 20%, some have even gone as far as 80 or 90% of the claims. And those are the ones that are going to face a concern right now in terms of paying that back. However, what we're also proposing now to protect the schools from that sort of thing, whether they did it wrong or not, to protect them, we want to introduce a new section within Section 40 of the VAT Act, which then says SARS cannot go back and reopen assessments, and neither can taxpayers, right? So if it's effective 1st of January 2026, it's going forward now. You can't look back and go back and assess them for this. At the same time, we've also introduced provisions that said, when you're paying in installments, your liability will only be due on those installment dates, because if we didn't put that, it would mean they would have interest and penalties. So that's another protection we're putting. Now, if we do not go ahead with this amendment from the 1st of January, there would be nothing to preclude SARS auditors from going in auditing space and saying, hang on, we want to see whether you applied the correct portion limit, and then they will have interest and penalties. So it's actually a protection for them that we put in the Section 40 and we implement on the 1st of January. So it keeps them safe from interest and penalties. Next slide, please. Okay, the other example we put in because people said that the comments the taxpayer gave was that the school fees will become more expensive for parents. Now, we put in this example to show you the difference between a registered vendor, that's a school that's registered for VAT, and the other one is not registered for VAT. So if you're registered for VAT now, you're a vendor, and if you have to exit the VAT system, you become a non-vendor. Let's take an example of cost of school uniform, for example. It costs the school 575 Rand, and they can claim an input tax of 75 Rand on that. So the total actual cost to the school is 500. Now, assume a markup of 20%, that's 100 Rand. It becomes something that's 600 Rand that they sell for. When they sell it to a parent for 600 Rand, because they're registered for that, they have to declare output tax of 90 Rand, which they're going to charge the parent. So the parent effectively is going to be paying 690 Rand. Now, assume that same school now exits the VAT system because of this amendment we put there now. There's the cost of uniform again, still 575. Now, there'll be no VAT input because they are out of the system. So the total cost is still 575. Again, assuming the same markup of 20%, 115 Rand, their selling price becomes 90 Rand, not 690 Rand. Because they're not registered for VAT, they cannot charge output tax on this. So they will be charging the parent 690 Rand. As you can see, they are aligned. There's no additional cost to the parent. Next slide. So from the examples, what we see is that that view of the higher cost of parents is a bit misplaced, right? Now, an additional benefit to introducing and taking schools out of the VAT system is that they will no longer incur those compliance costs that they pay to consultants and others to ensure they calculate the apportionment correctly, to ensure the VAT returns are submitted. So because they have to pay the exit VAT, like I said, we are giving them time from the first, another 12 months to start to budget for it and then just make payments in installments, right? And then there won't be any interest and penalties on that. Next slide. Okay, the other amendment that we're proposing from VAT is a low value importation of goods. This amendment is largely welcomed by taxpayers. What it's proposing, currently the VAT Act has a threshold in there for low value goods. So if it's below 500 Rand, or if it's booked under 100 Rand for customs duty purposes and there's no customs duty payable on it, then there will be no VAT goods. We've seen a large increase in offshore companies that are not based in South Africa supplying low value goods into the country, and the increase has been phenomenal in this regard in terms of sales into the country. And the difficulty is that local suppliers, whether even the ones that are on platforms, are suffering the consequences of this. Now, in order to level the playing field, we're proposing this amendment to remove those thresholds so that everything that comes in will be subject to VAT. And, we want to get the offshore suppliers on the same, put in the same position as the local one. So, like I said, it was largely welcome, but there was a concern because we did not put an implementation date. We said date to be determined by the minister. So the concern was that the foreign companies will continue to thrive at the expense of the local companies. And the request was that we bring the amendment, the implementation date closer, sooner. We can't accept this comment, even though we'd love to, because SARS are required to amend IT systems in order to make sure that this can be implemented in practice. So until that is done, we can't, it wouldn't make sense to implement this. Next slide. Okay, the other amendment, I think this is the last one for that, is clarifying the VAT treatment in respect of the National Housing Program. Now, this has been quite problematic over the years and difficult to analyze which ones are zero rated, which ones are standard rated. And the problem is that people have, unknowingly treated exempt rental stock as taxable. So we are proposing to reach clarity on this. And one of the things we want to do is to remove the reference in the VAT Act to the words National Housing Program contemplated in the Housing Act, and rather narrow it down to the housing subsidy scheme referred to in Section 35A of the Housing Act, because those were what could be seen as the traditional RDP housing. That was what the policy intent was. So what they're saying is they must consider the impact this will have on existing rental housing projects where people inadvertently treated it as taxable. Next slide. We cannot accept this because the zero rating did not apply to rental housing stock at all. It was always exempt in the VAT Act. And another thing that we have seen is that when it comes to the budgeting to municipalities, the departments have always included a VAT cost in what was budgeted for them. So but to now protect them, to make sure, again, like we did with the previous ones, to protect them from SARS going back and auditing and saying, you did this wrong and now we want interest and penalties, we are introducing a new Section 40 again within the VAT Act to make sure that past assessments that have been finalized can't be reopened by either SARS or the vendor. But where it's not been finalized, then if the vendor wants, they can make an application to SARS to consider reviewing such assessment. So it's actually more protective of the taxpayers in this. Okay, so the last comment on this was that there's no clarity on what constitutes a housing subsidy scheme, and it's not defined in the VAT Act and it's not defined in the Housing Act. So they want the VAT Act to define it. And we can't accept this because the Department of Human Settlements are the custodians of this. They are empowered to maintain the list of the housing programs that are considered part of the housing subsidy scheme, and then the VAT Act will just piggyback that list. That's it. Thank you, Dana.
Good morning, Chair. Good morning, honorable members. So I'll talk through some of the comments on the carbon tax related amendments. The two big issues was that we firstly proposed, as part of the amendments for the carbon tax, to extend one of the concessions under the Act to allow taxpayers to offset payments for the electricity levy as well as the renewable energy premium against their tax liability. This was part of the revenue recycling measures that was introduced under the carbon tax, and that ends at the end of this year. We propose to extend this commitment up to 2030, and this is to cushion households and energy-intensive companies against higher electricity pricing that we are facing. Some of the comments we received was, on the one hand, there was support for the extension of this commitment to electricity price neutrality by some stakeholders because of the impacts of high electricity prices, as well as some the challenges on Eskom's side regarding municipality debt. We can go to the next slide, Paul. And there were stakeholders on the other hand who were of the view that electricity generation should be covered directly under the carbon tax and payable. So they did not support this extension of the electricity price commitment. There was reference made to the amendments in terms of the Electricity Regulation Amendment Act, the restructuring of the electricity market, and the bringing in of additional independent generation. And there was support for the carbon tax as a key policy lever to help with influencing behavior of electricity generators towards more efficient and low carbon electricity generation, as well as influencing some of the decisions they make regarding the type of electricity that is dispatched. And there was a request and some proposals around trying to bring forward or reduce the timeline for the extension of this commitment. We can go to the next slide. We took note of the comments proposed. This proposal to extend the electricity price neutrality commitment until December 2030 took into account extensive comments received from stakeholders on the 2024 carbon tax discussion paper, as well as the concerns around the impacts of higher electricity prices in recent years. And the proposal provides an additional period of time for investments in generation capacity and will help to stabilize electricity prices to ensure the financial sustainability of Eskom. We do, however, take note of the proposal and the request to align the inclusion of electricity generators within the Carbon Tax Act together with the implementation of the ERA Act. We will conduct further research and policy analysis on some of the proposals that have been submitted with a view to make recommendations in future budgets on this here. The second big issue was we have in place the Climate Change Act, and under the Climate Change Act we have policies that have been proposed to allocate carbon budgets to companies. The Department of Environmental Affairs is implementing this policy, and it recently published regulations for public comment on bringing into effect this carbon budget system to help with compliance of the system and the emissions that's allocated to companies. We proposed a higher tax rate on those emissions of 640 Rand per ton carbon dioxide emissions. The comments that we received were some stakeholders, the first set of comments was around the design of this mechanism and around our proposal to apply this higher tax rate on an annual basis. Stakeholders submitted comments, and there were two main options that they put forward. You can go to the next slide, Mpo. The first option was that there was support for annualizing of the carbon budgets. However, there was a request for a crediting mechanism where there are fluctuations in the emissions within a carbon budgeting period. So here there was a concern around if a company exceeds its emissions that is allocated within a carbon budgeting period, then they would pay a penalty to SARS on an annual basis. However, there could be a case where over the 5-year period over which this budget is allocated, they would have complied with that carbon budget there. So there was a request for us to consider a refund mechanism for this scenario. And there was also a request for clarity on the basis for providing refunds under the Customs and Excise Act. And then the second option put forward by stakeholders was to consider applying this higher tax rates on emissions above the budget at the end of the 5-year carbon budgeting period. We can go to the next slide. So we considered both the options, and in principle, we agree that an entity should be entitled to a refund where they comply with the budget over a 5-year period, and to the extent that there are the emissions above the budget within that 5-year period, and there's a penalty paid to SARS, then they should be entitled to a refund. So we have accepted this comment from stakeholders to cater for this refund mechanism, and we've proposed amendments to the Carbon Tax Act, and this will enable companies to be able to claim a refund in the 3rd year within the carbon budgeting period based on approvals from the DFFE of the amount of emissions above the budget and whether they are complying with the budget, and then again at the end of the 5-year period. On the option 2, we considered the comment made. However, there is a risk of a large carbon tax liability for companies at the end of the 5-year period, so we have not accepted this comment. We can go to the next slide, Paul. There were some general comments around the coverage of the carbon budget mechanism and requests for clarity. So there was a request for us to clarify that the Carbon Tax Act only applies to Scope 1 emissions, which is direct emissions from a company, and not the Scope 2 and Scope 3 emissions. We can go to the next slide there. Yes, so we did consider the comments. However, we note that there is no need for any amendments to the Carbon Tax Act to clarify this, because the tax is very clear on the tax base and that direct emissions would be covered. We have also discussed with the Department of Environment, and they are working on methodologies to estimate Scope 2 and Scope 3 emissions. These are not part of the current carbon budgeting system, but at a later stage, they could be included, for example, in the 2nd or 3rd commitment period under the carbon budget. We can go to the next slide. There were some stakeholders that were of the view that the carbon budget amendments should be deferred until the DFFE finalizes and publishes the regulations on carbon budgets as well as mitigation plans. There were some concerns from stakeholders that they would not be able to accurately assess the implications of the proposed amendments. There was some suggestions around deferring the implementation on this up until 1st January 2027. And there were other stakeholders that were of the view that no penalties should be applicable for emissions exceeding the budget, and recommended a withdrawal of this proposal subject to engagement with stakeholders. We can go to the next slide. So again, on these proposals, we had extensive discussions with the Department of Environment as well. The department conducted an extensive consultation process on both the voluntary carbon budgeting system as well as the mandatory carbon budgeting system. This included consultations on the framework and methodology for determining budgets, which was approved by Cabinet, as well as specific consultations with industry associations and companies on the carbon budget and mitigation plan regulations. Taking into account this extensive process, we are of the view that the deferment of the budgets is not necessary, and we don't accept this comment. We can go to the next one. Again, just to say that there's been extensive consultations between the department and stakeholders, and companies are encouraged to engage the department on this there. In addition, the draft amendments that have been put forward related to the higher carbon tax rate on emissions above the budget and will only come into effect after the DFFE finalizes the regulations, and the Minister of Finance will publish by way of a notice the effective date. This will be aligned with the implementation date of the carbon budget system of the department there. There were two additional design requests regarding the carbon budgets. Firstly, there was a request for some of the tax-free allowances to be allowed for the carbon budgeting system. Some stakeholders requested this, while other stakeholders strongly opposed this, and as well as the use of any carbon offsets under both the carbon tax and carbon budgeting system. Or you can go to the next slide. The second part of it was there was also a request to extend the electricity price neutrality commitment and some clarity around this to the carbon budgeting system. We can go to the next slide. So all of these comments were considered. The proposal did not include the extension of the electricity price neutrality commitment to the carbon budgeting system, and it also did not allow for the tax-free allowances. The main reason for this is that the carbon budgets are catered for within the Climate Change Act, and it sets out the various factors that need to be considered in determining the budget. This includes estimating the socio-economic impacts of imposing the budget, the best available science available and information, the options available to mitigate emissions of greenhouse gases, how this aligns with strategic priorities, the alignment of the carbon budgets with our greenhouse gas emissions trajectory and targets that we set for the country, as well as the progress made by companies in terms of its implementation of the greenhouse gas mitigation plans. This provides significant flexibility in terms of the level of the budget that is allocated to companies, and additional support measures are therefore not necessary. We can go to the next slide. There were some views from stakeholders and some general comments on this regarding concerns of double taxation under the carbon tax and the carbon budget, this non-compliance mechanism, and there was a request for clarity on whether there's any interaction between the formulas for the determining the carbon tax that is currently there, as well as the carbon budget non-compliance mechanism. Overall, the carbon tax is a market-based instrument. It specifies the tax rate and the price of greenhouse gas emissions, and in that way, it provides incentives for behavior change. On the other hand, the carbon budget sets a limit on the amount of emissions from companies and various entities. It is a command and control instrument, so that target has to be met. We view the two instruments as complementary, with one providing certainty in terms of the tax rates, and the other providing some certainty around the emission reductions on the margin, and for that reason we don't view a direct interaction between the two instruments in this first phase of the carbon budget. So this comment was not accepted. We can go to the next slide. Or next slide. Thanks. There were some concerns from stakeholders around the rates being too high, and requesting clarity on how the rates were determined, as well as on the other hand, there were stakeholders who were of the view that the carbon tax rate is too low to ensure compliance with the carbon budget. It is not aligned with the Paris Agreement targets to limit warming to around 1.5 degree Celsius, and a higher rate is needed together with annual adjustments to this tax rate, at least by inflation. We can go to the next slide. We noted the comments that have been provided, and if you look at the carbon tax rates that have been put forward to meet the commitments under the Paris Agreement, they are quite wide-ranging, and they range from around $46 in 2025 to around $90 in 2030. This took into account work conducted by the National Business Initiative in around 2021-2022. From a South African perspective, some of the carbon prices that were put forward was a tax rate of $25 in 2025, increasing to $40 in 2030 without any allowances. There were various modeling studies conducted on the carbon tax in general, which showed that through the phasing down of some of of the allowances and increasing the effective tax rate, that this will contribute to our emission commitments. An appropriate recycling of some of that revenue would mitigate adverse impacts on economic growth while promoting investments in key industries as we grow. This higher rate is aligned with the lower bound of the levels being put forward to achieve the Paris Agreement goals. It gives effect to the polluter pays principles, and it helps to ensure a progressive carbon tax design where companies do not invest in alternative cleaner technologies linked to their mitigation plans, which is required under the Climate Change Act. They would face a higher tax rate. However, to the extent that they make the investments required to comply with their plans, then they will face zero penalties. The overall impact on companies will also depend on the stringency of this carbon budget, which will be determined by the Department of Environment. So it provides significant flexibility to ensure that our commitments are met in terms of the Paris Agreement, as well as provide that space for growth there. We can go to the next slide. That was quite a lot, so I'll be quick through these slides here. Under the Carbon Tax Act, we allow for companies to claim a carbon budget allowance to the extent that they participated in the voluntary carbon budget system. In the budget, we propose to extend this carbon budget allowance to the end of this year to allow for the finalization of the mandatory system. We can go to the next slide. This extension was supported by stakeholders and noting that the carbon budget allowance will come to the end at the end of this year, and we accepted this comment. The second set of comments that came through was a request for an extension of this allowance by a year to allow for the carbon budget and mitigation plan regulations to be finalized. We can go to the next slide. In terms of the design of the carbon tax and the proposals that were put forward in the discussion paper, with the falling away of the carbon budget allowance at the end of this year, we propose to increase the carbon offset allowance by 5 percentage points from the 1st of January 2026, and that will mean that the offset allowance for emissions will increase to a maximum of 15%. And the intention of this increase was to help to stimulate domestic activities under the carbon market and provide incentives for additional low carbon investments and technology innovation. Companies that fall under the threshold for the mandatory carbon budgeting system and continue to operate in the voluntary system would be able to access this allowance. So there would not be a decrease in the overall level of allowances that companies can claim there. We can go to the next slide. There, I'll stop there and I'll hand over to my colleague Kushle.
Thank you, Charlene. Good morning, Chair and honourable members. I'll speak to some of the remaining slides regarding the carbon tax proposals. In terms of the sequestration deduction, it was proposed in the draft TLAB to expand the carbon sequestration deduction for the paper and pulp sector to include third-party timber providers, and that this will be in accordance with the newly approved protocol by the DFFE. The comments from stakeholders largely supported the expansion and the proposal. However, there were some suggestions to strengthen the measurement, reporting, and verification procedures. Stakeholders requested that the administration and registration processes be streamlined in order to reduce any administrative burden, particularly to small-scale growers. Next slide, please, Paul. Some of these proposals included developing a centralized registration portal, having a risk-based tiered verification approach, as well as having an annual self-certification with the random audits to ensure compliance and data integrity. In terms of the response to these comments, these are partially accepted. In terms of the third-party registration, the South African Greenhouse Gas Emission Reporting System, or the SAGES, will be enhanced to enable third-party timber growers to register their plantations. The system enhancement will include opportunity for growers to capture key information such as the harvested area, the proportion of harvest purchases, as well as the harvest volumes and their specific geospatial location references. The DFFE will also initiate discussions with PAMSA to explore integration of a risk-based tiered verification approach into the existing protocol. This will be guided by the approved protocol as well as relevant ISO standards, with further engagement plans with the sector to develop clear guidance and implementation strategies. Next slide, please. The DFFE also supports the introduction of an annual self-certification process, which will be subject to the condition that the third-party growers are registered with the Sustainable African Forest Assurance Scheme on the value-based platform system. Under Section 6 of the Carbon Tax Act, the sequestered emissions must be certified and verified by the DFFE for a specific tax period. An additional requirement for the sequestration deduction to be approved by the DFFE, and the department confirms the specific amount to be sequestered of the sequestered emissions in writing is proposed. This document can be submitted to SARS by the taxpayer in order to claim the sequestration deduction. Next slide, please. In terms of the Schedule 1 of the Carbon Tax Act, to align with the DFFE approved factors, changes to the carbon dioxide emission factors and net calorific values for coal, natural gas, and methane-rich gas contained in Schedule 1 were proposed in the TLAB. The comments suggested that there should be an alignment of Schedule 1 emission factors with the DFFE approved country-specific emission factors to apply the 2024 DFFE approved emission factors and net calorific values. Stakeholders who have reviewed that the net calorific values for methane-rich gas should be updated and aligned with the latest DFFE approval. The response is that this is accepted. The TLAB amendments were aligned with emission factors and NCVs that were approved in 2023. In 2024, the DFFE did approve updated changes to country-specific Tier 2 emission factors for natural gas and methane-rich gas through a letter that was provided to stakeholders. So it is proposed to amend the draft TLAB to align with the emission factors for natural gas and the net calorific values with the DFFE approved factors for the reporting period of 2025 to 2027. Next slide, please, Nicole. The DFFE, Treasury and SARS have discussed the department's process for applying changes to Tier 2 emission factors and aligning with the budget and TLAB processes for effecting changes to Schedule 1 of the Carbon Tax Act. There's acknowledgement that there is a delay of at least 12 months between the changes of the factors effective for initial reporting and the carbon tax. Given the budget, the TLAB, and the parliamentary process, it is therefore proposed to amend the Carbon Tax Act to allow the Minister of Finance to adjust emission factors and other values in Schedule 1 of the Carbon Tax Act by way of a regulation. The changes to the emission factors will be aligned with the DFFE approval process, and the amendments will be ratified in the following year through the TLAB to ensure that there is parliamentary oversight over the changes. Thank you. Paul, over to you, Charlene.
Thanks, Kushle. So two last issues. There were, in general, from comments that we received from stakeholders. So there were requests for the public comments and submissions to be made available to all stakeholders. This comment was noted, and we will engage with stakeholders on the publication of these written submissions, noting that there is confidentiality around some of the information contained in the submissions. And the second general comment was So stakeholders noted the publication of the 2024 discussion paper on the carbon tax proposals and supported the phasing out of tax-free allowances and strengthening of the effective tax rate. There was a request for us to provide a schedule on how the allowances would be adjusted over time and to address concerns around potential adverse impacts of the carbon tax. Some stakeholders suggested that revenues from the carbon tax should be recycled to provide us temporary assistance to emissions intensive and trade exposed industries. We can go to the next slide. So this comment was noted. In the 2025 budget, we had announced the intention to retain the basic tax-free allowance until 31 December 2030. This took into account the stakeholder consultations on the discussion paper and the concerns raised around the availability of low carbon technologies, the higher electricity and energy costs, issues around competition from imports, and logistical challenges, among others. And in the budget, we announced that we intended to consult with the Department of Environment, the Presidential Climate Commission, and other stakeholders on the options to reduce the basic tax-free allowance from the 1st of January 2031. So it is the intention to continue with that process on technical engagements around that there. Thank you. I'll hand over, Mpo, I think, to the SARS team. Thanks.
Good morning, Honourable Chair and Honourable Members. So we'll begin with the Tax Administration Laws Amendment Bill. If we can move on to the next slide. So the issue here is that public benefit organisations that have both Section 18A and non-18A activities require a certificate to demonstrate that the funds have been applied correctly for the 18A certificates. And there have been some concerns around this. So moving along to the next slide. One of the concerns is that the reference to an audit certificate suggests that an audit is required. That was not the intention. So the commentator here welcomes the fact that we are moving away from that and removes any confusion here. We'll continue to tweak the wording there to ensure it's clear. But commentators also raise the issue that if you read the legislation coldly, what is required is 100% testing. And that is impractical and would be very, very expensive. So moving on to the next slide, that is accepted. We'll be proposing that the 100% requirement be relaxed to a reasonable satisfaction standard. So that you don't have to test absolutely everything, but you need to test enough to be reasonably sure that the funds have been applied appropriately. The initial proposal also suggested that this needed to be done by an independent person, but a lot of comments came in as to how exactly to deal with the concept of who an independent person was. There were some rather ambitious proposals around that, but actually would have just added to complexity. But some proposals suggested that we go with a registered tax practitioner because that's a known framework. And so that will be the proposal that we will be making in the formal bill. And then around the question of what this reasonable satisfaction would entail, that is something that we would propose to deal with in an interpretation note so that there is a degree of flexibility around how it would be set and the engagements that can be had. Moving on to the next slide. So this is a very widely welcomed set of proposals. This is to extend the concept of a voluntary disclosure program into the customs space, because currently it is in the tax space, so customs and excise does not have such a thing. And so the suggestion, the proposal that was made was to extend it on a very similar basis. And so moving on to the next slide, generally speaking, this was a very widely welcomed proposal. There were some questions around, is this a permanent issue? And the answer is yes, this doesn't have an expiry date, and we will be modernizing our relevant systems. There were also some questions of clarity. Do you have to have one application, or would the VAT on import also be dealt with in terms of the Customs and Excise Voluntary Disclosure Program? And the answer, if we move on to the next slide, is yes, only one voluntary disclosure needs to be made. We're trying to keep things compact and easy to handle. Moving on. We have the VAT modernization. Hang on a second. VAT modernization. So this is a set of initial building blocks to allow a voluntary model and voluntary e-reporting. So moving on to the comments. Next slide, please. So there was a rather ambitious comment, which was that this is going to be a very expensive program if both government and private sector costs are taken into account. And perhaps we should look at something else. That something else is very similar to a sales tax, a multi-tier sales tax. So whilst the proposal is noted, that would be a very, very significant change from the international trends that we see around the globe over the last 30 years and longer. And so there were also reasons we moved away from a sales tax back in the day to a value-added tax. So those would all have to be revisited, but nevertheless noted for future review and consideration in the tax policy space. Moving on, the comment was made that we need to make sure we don't leave smaller businesses behind. Absolutely. The idea is that we will have a very broad range of consultation. We probably would start with the larger businesses because they have the systems in place already that would probably allow them to come into this. We've already had some expressions of interest to join on a voluntary basis. So that is something that we would be exploring further. Okay, then a number of issues were raised around factors that we would need to consider in bringing such a system into place, including the global lessons, economic assessment, funding and transition risks, and various practical considerations. Moving on to the next slide. Very much understood. All we're doing here is creating the initial building blocks for a voluntary system. There's a consultation paper that is going to be coming out before the end of the financial year that will provide a basis for a very broad set of engagements to make sure that we understand the issues, that we've engaged on a collaborative process to bring this forward. But again, we're not trying to run before we walk, which is why we've started with the basic building blocks and a voluntary e-reporting system. Moving on. Now, what we're dealing with here is a requirement that before you go to the High Court to take SARS on review, you need to give SARS some notice of that fact. That is generally welcomed by the legal system because it allows SARS an opportunity to correct the issue before both sides end up spending large amounts of money and taking up a judge's time. Now, the issue here was that we were suggesting that what needed to happen was that the notice be in a prescribed form and manner, and the concerns were raised around that. And when we looked at the issue, we saw that where that proposed amendment was located may have given the suggestion that we were seeking to impinge upon the High Court rules and the form and manner used there, which was clearly not the intention. It is simply the intention for this notice to be in a prescribed form and manner. So we partially accept this one if you move over to the next slide. And we will move it to another provision, subsection of that, section 11, where it'll be a little clearer that all we're dealing with is this notice. And if there's still a residual concern that SARS would be unreasonable in this notice, or would unreasonably apply people not meeting the form and manner, the key point here is that the High Court has the discretion here as to whether to accept the taxpayer's person's application. And if SARS were being unreasonable, the High Court would simply waive that requirement. and there are circumstances where you can, in fact, petition it even without having put a notice in at all, so the courts retain control over who has access to them, and that is specifically recognized in the law. Moving on. Now, in the VAT system, we have a situation where sometimes people try to defraud SARS. They create fictitious businesses, they try to register them, and then they claim large refunds. Or else they create what are known as invoice factories, where they assist other people in claiming large refunds. And so sometimes, if the risks reflect that it's required, SARS actually goes out to inspect the premises to see if they exist and if they are suitable. So if someone says they've got a large manufacturing business, but it's a residential address, clearly there's something wrong. So the proposal here is to permit SARS to go out and do these inspections. There are some concerns here about bottlenecks. And by the way, it's not just in VAT. It would also arise in some other areas where there are tax concessions, just to make that point. So the concerns here are around VAT registration and bottlenecks. And moving on to the response, we've noted that we already are doing this by arrangement. So we're just essentially ensuring that there's a legal basis for doing it. It is a tiered approach. We don't try and do it for everyone. And we're not anticipating an impact on the timelines. We're not proposing a change to the SARS service charter around the 21 business day turnaround time. So this is a selected approach to ensure that we can deal with risk. Now, here is a taxpayer favorable amendment. We're making it clear that if, for example, you've received an auto assessment and you're taking a little bit longer than you would anticipated to get a response into SARS, you can request that the due date for payment of the amount involved be deferred. So a suspension of debt. Now, the issue that was raised by the commentator was, well, thank you very much for that, but please make sure your systems work that way, because currently they don't. We try and put in a request for suspension in another context, and it's automatically denied. So moving on to our response on the next slide. Now, I would really appreciate it if that particular practitioner that raised this could surface this through the usual channels or directly with me as well. But we've engaged with our systems colleagues, and the system does permit you to make such a request. Now, it may well be that the commentator is referring to something else that we've picked up. So you do get your 80-day suspension, but you have 80 days to put an objection in, 80 business days, that is. And if you don't put your objection in within that period, the suspension is automatically revoked, which, if you think about it, is logical. You said you were going to put an objection in, you didn't. So the system says, well, then you still owe us the money, and would you please pay it now? But we are aware of cases where, because of unanticipated programming interaction, some of the suspensions are revoked earlier than the 80 business days. So thanks to the commentator, if that's what they were driving at, it has been surfaced with our technical teams, and they are looking at the matter and assure me that it will be rectified. Then we get to a fairly contentious change, which is to clarify the scope of what a bona fide inadvertent error is. Now, the comments here were detailed. If you go and have a look at the Word response document, you'll see there are detailed comments and detailed responses from SARS. But perhaps the best way to deal with this one is to jump ahead. I think it's to slide 4 of the section. So please go on to four slides, please. And again, and again, and here we go. Right, thank you. So the example was floated in the presentation to the committee that this was unfair, because what would now happen would be that a person with a large understatement, let's say 2 million rand, could rely on this bona fide inadvertent error, but someone with a small understatement, say 25,000 rand, could not. So let's walk through that one. And this was someone who'd gone to a tax practitioner, got advice, and completed the return on that basis, and SARS had disagreed with it. So in this circumstance, it's fairly settled law that if you went to a tax practitioner and relied on the advice, you have reasonable grounds for taking your position, and you took reasonable care to complete your tax return. So those two USPs categories do not apply to you in the table. So no penalty in terms of those two. And if anyone doubts that, you can go and have a look at the Thistle court case in the Constitutional Court where that very approach was confirmed. Now, that then leaves a substantial understatement. And the small taxpayer with the 25,000 Rand difference is not faced by a substantial understatement penalty. Doesn't apply to them. So they have no need for it to go any further. They can stop at that point. However, if you are a large taxpayer with a 2 million Rand issue, a substantial understatement penalty does apply to you. And now we have to get into a mechanism to let you off it if appropriate. And that is precisely the point of this. We are bringing this particular mitigating factor into play for the very purpose where it is required, not trying to apply generally where the exception ends up swallowing the rule. So I hope that assists, but for those who are interested in the detail, the slides give you a taste of just how detailed this can be, and hopefully the Word document takes you even further. Moving on. Next slide, please. And that just reiterates the point I've made, and moving on again. Right, now we come to a technical point, which is because of where the concept of a bona fide inadvertent error was moved to, the wording in the draft legislation suggested that SARS needed to be satisfied there was a bona fide inadvertent error. There is no current requirement that SARS be satisfied, and taxpayers took issue with that and said, well, now you're making it a discretion and you are reducing the reliance that taxpayers can place on this. To some extent, we think that was based on pre-constitutional error interpretation of administrative action, but nevertheless, in order to address the concern, we will maintain the status quo, and SARS will not be required to be satisfied that there is a bona fide inadvertent error. We'll simply make the point that if there's a bona fide inadvertent error, there's a mitigating factor, and then SARS needs to be satisfied for the other mitigating issues that there was an opinion by a registered tax practitioner, proper disclosure, and so forth. So we maintain the status quo in that regard in the concept of a substantial understatement. Moving on. Right, so now there's a suggestion that we're attempting to override principles in the legislation. So we don't see that. Moving on to the next slide. We're not changing anything. Bona fide inadvertent error remains. All that changes is where it's located. And for those who require the reliance on the bona fide error mitigating factor, they are able to make exactly the same submissions that they were able to make before, relying on the cases that have been quoted by commentators. I would just interpose to make the point that the Constitutional Court did suggest that there was a reasonable prospect of either of two interpretations, being SARS's or taxpayers' interpretations of this particular term being correct, but they declined to rule on it because of the specific facts of that case. And again, we come back to the Thistle Trust case in the Constitutional Court. But in as far as the interpretation of the term, it remains what it is. Moving on. So finally, we come to quite an interesting proposal, which was that we should add another category into the understatement penalty table, which was that of reasonable care taken. Now, the difficulty with that is that the penalty table is for unacceptable behavior, and this would confuse matters by adding a line that is for acceptable behavior in the list of what is unacceptable behavior. But we do take the point, which is that some readers may think that the wording in section 2.2 sub 1 means you must always impose a penalty, even if none of the behaviors in the table exists. We think that is a strained wording, but we accept that practical experience may suggest otherwise. So the proposal then is to clarify that the understatement penalty only applies if the behaviors in the table exist. Just to make it crystal clear that that is the case, our view is that that's probably not required, but given the concerns expressed, it was thought best to make it absolutely clear. I think that brings me to the end. Yes, it does. I'll hand back to the TDG. Yours, Chris.
Thank you, Chair. We're done from our side, so we're happy to take comments and then provide any additional responses later if required. Thank you.
Thank you, Team Treasury and SARS. We're going to give an opportunity to the stakeholders to raise, to make comments actually in terms of their own submissions. And I think it's also good that both the Treasury and SARS were able to point out areas where they agree or disagree, areas where they are accepted, but also are able to give and provide reasons, because this is one of the areas that stakeholders have been raising issues that they do not know when SARS or National Treasury has, accepted some of the recommendations and not. Now, I'm going to provide 3 minutes for each stakeholder to make comments, and we stick to that. So we're going to start with Heineken, and then go to South African breweries, South African wines, SA Liquor Brand Owners Association, South African Institute of Chartered Accountants, SAICA, South African Institute of Taxation, PKF, Tax Consulting, Just Share Association on the Investment of South Africa, Old Mutual Institute Retirement Funds, WWF. Now, when you are supposed to be coming up and you are not making a presentation, because we are going to be timing up for 3 minutes, you are going to have to forfeit. I'm not giving you pressure, but I'm saying it's 3 minutes and you've got to be ready. And please, let's not rehash what we have made a presentation on the public hearings. Let's stick to what have been responded to. Thank you. Can we start with Heineken Beverages?
Morning, Honourable Chair. Thank you. Carmen Fanikak here for Heineken Beverages. Chair, through you also, good morning to the other honourable members, to the SARS and Treasury officials, my colleagues and other stakeholders. Thank you for the opportunity to respond. Chris and Mpho, thank you for your comprehensive response on the excise. I think there are some comments I'd like to make on MUP, etc., and I think we'll leave those for the Treasury workshops that will commence on Thursday. I think my primary statement as a response to the information that's been shared, Treasury has stated that its key objective is to balance revenue collection and harm reduction. And I would contend that the key focus for the industry together with Treasury has to be to tackle illicit trade in order to achieve these objectives. As I've shown in my submissions 2 weeks ago, the harm reduction indicators have really improved according to the WHO data. And if illicit grows unchecked, it will erode all the progress that has been made to date. In addition, I feel there is a bit of a disconnect in terms of the statements that have been made around the link between excise policy in the tobacco space on the one hand, and the absence of a link between the excise policy and the illicit in the alcohol space. I am worried that the lessons learned from tobacco are not being translated so we can preemptively tackle the illicit growth in the alcohol space. And for that reason, I'd like to submit to Treasury that, as you have been doing for alcohol, that the excise increases, as you have been doing for tobacco, the excise increases for alcohol should be limited to inflation so that we can support the fight against the illicit trade. Thank you. Thank you, Chair.
Thanks very much, Carmen. South African Breweries.
Good morning, Chair, and good morning to the members, as well as to the National Treasury officials that have provided feedback on excise tax increases in particular. So I'll answer specifically to the slide around the necessity of trade-offs. And of course, there are opportunity costs to balancing the fiscus and ensuring fiscal sustainability as the primary objective of the National Treasury and the Minister of Finance. But that does not discount the Treasury's opportunity to provide tax certainty as it pertains to the excise taxes. And having put in place an excise tax policy with the hope that this would, in essence, give the industry a framework in which to comply with the excise tax, I do not think that there is one over the other in terms of fiscal policies and the tax policy frameworks that exist for excise taxes and the other instruments that should be discounted. So I do think as a response, and it would be great to hear from the National Treasury team in the intentions, in the long-term intention to ensure fiscal sustainability, does that mean discounting the principle of tax certainty? There has been a multiplicity of responses from all the National Treasury officials with regards to providing taxpayers with tax certainty, and yet on the excise tax, the Minister's discretion has been stated, but nothing has been said about providing the industry with tax certainty and the guidelines of the excise policy thereof. On another point, Chair, was around the argument that there has been no, there has been no data point provided in this regard, but at least anecdotally that there has not been a pass-through of the excise tax increase to the consumer by the way of price. I think that in terms of giving the extensive nature and technicality to the rest of the tax instruments, it would be great if the National Treasury would provide the data path, at least in time series form, around what they see the discrepancy between the excise tax increase and the pass-through, at least to give the industry a sense of why and the intention behind including another non-tax intervention through minimum unit pricing to correct for that. So there's the one question around the nature of the correction, what is the discrepancy between price and the excise increase, and then thereof the suggestion around minimum unit pricing as the suggested non-tax intervention. So I do think going beyond the anecdotal response, there are some technicalities that we would love to hear from the National Treasury team around the main feedback on the excise tax increase. Thanks, Chair.
Sir Wines.
Good morning, Chair. Chris Conradi from SA Wine. Thank you to Chris and Mpho for the presentation. I think what's really important for me is also to walk in the shoes of National Treasury. And I think we're asking exactly the same for National Treasury to walk in the shoes of business. We're not doing business at the expense of health and or consumers. We're doing business for the reason why all of us are in business. We're all bottom line driven, but we will do that with responsibility.
That's why in the liquor industry, there's a Liquor Products Act, there's a Liquor Act, and then I can mention a couple of more compliance interventions that we need to adhere to moving forward. I think what's important here, and I'm just glancing at the one page that was part of your presentation on the 30th of May, on page 19, you mentioned there also
Can we get assistance there? Yeah, it looks like our network is losing a bit. Can you hear me?
Yeah, we can hear you,
Okay,
Chair.
why-
Is it all of us who had this technical glitch, or?
Yeah, we can hear the chair, but
Yeah,
we
it
can't
looks
hear the
like-
presenter.
Yeah, no, the presenter had a challenge as well. I think he had a glitch. Can we get SA Liquor Brand Owners Association? We'll get back to SA Wines.
Thank you, Chair. Good morning, honourable members. Thank you very much for the opportunity. This is Kurt Moore from the South African Liquor Brand Owners Association. First of all, we'd also like to thank Treasury and SARS for the detailed feedback. We thank Treasury especially for the feedback regarding excise. We certainly, as SALBO, welcome the additional resources that's been provided to SARS to combat illicit trade of alcoholic beverages. As a stakeholder who's been actively involved in combating illicit trade, we look forward to working with law enforcement, SARS, South African Police Services to try and combat illicit trade. We'd like to argue that the challenge of illicit trade is not one of just sheer enforcement and law enforcement. I think in the absence of law enforcement operating optimally, we would argue that policy also has an impact on the growth of illicit trade. And we're thankful to Treasury for recognizing that there is a nuance in having to deal with this challenge. With that, Chair, I thank you.
Thank you. Can we then have British American Tobacco SA?
They won't be making any comment in the meeting, sir.
Thank you. Can we then have Saika?
Thank you, Chair. I'm trying to see if I can undo my camera. Okay. Chair, thank you very much. And thank you to the responses from SARS and National Treasury. Chair, just three matters I will not deal with. So on the first is just two matters on what was not responded to. I think one was on the consultation process. And again, quite important on the consultation process and how we get to revised drafts, looking at last year's process and this year's process, and the opening statement in the response document that once the amendments are done from the proposal document, they will be tabled by the minister as a bill. However, there doesn't seem to be a parliamentary process to actually do consultations on those changes, and the public would not have had an opportunity. So I leave that with the honourable members to decide and debate how we address that concern, that the final bill as tabled, and whether it is, or maybe we just don't understand the process, and maybe just some clarity on that. On the rates bill, the submission regarding the fact that some of the rates have not been adjusted, some are policy matters. They are, in fact, not tax threshold matters. And I think the honourable members that raised it in relation to something that is currently discussed, which was the understatement penalty and the R1 million that has also remained the same since introduction, was a good example of how that. Chair, then on the VAT on schools, given it's welcome that the proposal is deferred. However, given the requests by the schools organisations, given that it has now been preferred and this is something that Treasury is trying to help schools, I think it's important that we get it right, and that maybe the proposal be deferred and not implemented in the cycle, but the next cycle, so that all the refinements to the actual final proposal can be made. Chair, and I'll then finish off with the last proposal, namely on the notice of legal proceedings. We note the proposal to move the actual provision from 11.4, namely the part of it, to 11.5. Both of them, however, are both constitutional limitations to access to court. They're no different, just two different ones. And I think, importantly, again, this is relief by the courts for taxpayers. Having form requirements is a further limitation. It's further than any other government institution is allowed. Even the current one is further than that, and it is not necessary. The comment from SARS that, well, people can just go to court, it does mean that you now end up in litigation to deal with whether SARS actually appropriately applied the form requirement. And then only if once you've actually dealt with that, you now get to go to court to actually deal with the administrator, which is unnecessary. If there are concerns from SARS or if something is malicious, the courts will in fact then be able to decline any access to courts, etc., without delaying the process, as well as provide SARS with a cost order should it be something malicious with no grounds. Chair, I leave it there on those comments. Thank you very much.
Thank you, Staka. Can we have SA Institute of Taxation, Said?
Thank you, Honourable Chair. Thank you, Honourable members of the committee. By way of introduction, my name is Kitimita Sisana, the Acting Deputy CEO of SAIT. We'd like to firstly thank our colleagues at National Treasury and SARS. We do appreciate that this was quite a weird fiscal year within which to operate, but we have recognized that there's a lot of changes which we had requested in our submissions as the SA Institute of Taxation that you have taken on board, and thank you for listening to South Africans. Firstly, of course, we'd like to congratulate and welcome the fact that you have partially accepted the reasoning upon or the basis of our submissions in order not to proceed with the amendment to section 10.1G cap C2, the partial acceptance thereof. This was going to create a massive problem for South Africans. I think we ventilated that ad nauseum in our various fora, so thank you for that. On the carbon tax, there's many amendments that we specifically came through. Gushle, thank you for recognizing our submissions in terms of sequestration deduction and section 12H. I think the previous presenter before me has ventilated that in full. We appreciate the additional protections that you're putting in place for the schools who may not have access to tax advisors and have been operating on this mixed supply basis and erroneously calculating their apportionment. However, we must make mention that there are certain amendments that we did make commentary on that National Treasury has noted and not fully accepted, such as the proposed amendment to section 20 cap A. We still vehemently propose that this not be reduced to middle income earners who are already stretched by the fact that tax brackets have been frozen for quite some time. Thank you to Zadisile for giving us that example, which we did request, and we do agree with the rationale that there should not be cross-utilization of assessed losses, but we also would like to further reiterate that those in the middle income tax brackets are just merely trying to supplement their income as a result of not having any relief. And then, of course, to Mr. Tomasek on the bona fide inadvertent error. Thank you for your presentation thereon. We'll go into it in more detail, but the partial acceptance that SARS cannot operate on both sides, having to be satisfied that it is indeed a bona fide inadvertent error. Thank you for conceding on that one. E-modernization and VAT, we still propose that although those that are coming voluntarily, there might be a couple of issues in real-time reporting, but we will make those submissions. Chair, I see I've reached my 3 minutes, and just on that, I'd like to thank National Treasury, but on the proposals that were noted or partially accepted or actually outrightly objected, we wish to just make further commentary in some way or form to try and meet each other halfway. Thank you, Chair.
Thanks very much, Gitumitsi. Can we get to PKF?
Thank you, Honourable Chair, and morning to all. My name is Paul Gehring. I'm from PKF. I'd like to just address a few issues. 3.3 on the ring fencing threshold. Our proposal was solely a carve-out for fixed property, rental property, the buy-to-rent sector, and not for what would otherwise be some of the suspect trades recorded. On 8.4, dealing with the low-value importation of goods, I think in light of the verbal comments, it's probably more appropriate to have called that noted as opposed to not accepted. But the reality is it's a very broad delay. And I think that South Africa ought to be given some undertaking as to when the computer would make itself ready to meet the actual needs of the country and the fiscus. We have a serious problem with these imported goods, and that should be addressed. 10.6 on the VAT modernization. I note that our comment has been noted, and we are more than welcome to be part of any further deliberations in that regard. 10.10, the issue of the suspension of payments and the comments that were made there that SARS is not aware of any outright rejections. With respect, this has been brought to SARS's attention on a number of times. The suspension is made and then rejected very soon thereafter on the grounds that the objection has not been lodged within time, which is factually incorrect because the 80 days have not run as yet. So there are system problems with that. And then if we deal with 10.11, the last issue that I'm going to deal with, we have concerns about the fact that the SARS auditors do not take heed of the comments made at, for instance, page 84, where it says that reliance on professional advice prior to taking a tax position is generally regarded as reasonable. We have problems that the default position inherently for auditors is that reasonable care has not been taken. And with that being the default, the taxpayer is put to great cost. So we are interested to see how at page 91, our submission that the extra line be added as a behavior, and how that will be amended, and hopefully that will achieve some clarity. But at the moment, the unfortunate position is the smaller taxpayer is met with the might of the law, and the larger taxpayer has so many outs that it is not paying any level of penalty proportionate. I thank you for the time.
Thank you, Paul. Can we get to Tax Consulting SA?
Thank you very much, honourable members and everyone who has participated in this. Very much share the sentiment to my colleagues. Very much welcome the partial acceptance of the submissions given. It really has been a constructive process, if I may say. And again, as echoed by Sat, happy to be involved in anything further required in terms of insight or contributions to where this amendment can be implemented on a basis that is acceptable to everyone who it does affect. That's all I have to submit in this regard. This is specifically referring to the Section 10.1 GC2 Foreign Pension Exemption Amendment. And I'll keep it short and sweet. So thank you very much to everyone in Parliament, Treasury, as well as SARS. Thank you.
Thanks very much, Tax Consulting SA. Can we get to Just Share? Just share. If they're not in, can we get the Association for Saving Investments? SA.
Good morning, Chair. Honourable Chair, can you hear me?
Clearly.
Good morning, Honourable Chair and members. It's Chris Benneker representing ASISA. We just welcome the presentations and the feedback from National Treasury and SARS. In terms of the specific things that we gave verbal presentation on a couple of weeks ago, we note and welcome the withdrawal of the foreign pension proposal, the withdrawal of the proposal to remove CISs from the provisions of Section 44. Both those withdrawals we think are right. With regard to Section 42 proposal, the asset for share and CISs, we note that the proposed implementation of any amendment has been postponed to 1 January 2027, and we welcome consultation on that matter, consultation with National Treasury to have specific, if it needs be, to have specific targeted provisions which address the abuse they're concerned about. As regards the STT exemption for the proposed introduction of an STT exemption for in-specie transfers into CIS portfolios, we welcome that. That will help to clarify matters. And then lastly, we also welcome the fact that capital distributions by CISs, these will lead to the reduction in the base cost in the hands of the holder of a unit holder in a CIS, rather than the whole cash distribution being subject to capital gains tax. So in general, we welcome the proposals and we thank you for your time. Thank you.
Thank you, Chris. Can we get to Old Mutual?
Hi, this is Faisal Khan here from Old Mutual. And maybe I had missed the point about capital distributions that Chris just raised. Because if I look at the comments on capital distributions, we, as well as ASISA, had asked for the capital distribution to reduce base cost first, and the comment merely says noted, but doesn't say that it is going to change. So I'm not sure if I've missed the point on that there. On that point, we just like to highlight that when the original discussion document came out, Old Mutual, as well as ASISA, asked for the reduction in base cost and not for the distribution to be a capital gain. The reasoning given in the document is that CISs could not track the base cost of the investors. I'm not sure where that comes from, because in our understanding, CISs are required to track the base cost because they need to make an IT3 disclosure on capital gains when the unit holders dispose of the units. The second one, or just a little bit of clarity we required. In our presentation, we had asked about the regulation for unlisted REITs and when we expect these to be published, and if National Treasury is possible to give us some indication of when these things would be published. Thank you.
Thank you. Further, can we have Institute for Retirement Funds?
Good morning, Chair, and good morning, members. Chair, we are comfortable with what Treasury and SARS has presented. We welcome the withdrawal of the foreign pension, the tax on the foreign pensions, and we appreciate the engagement from National Treasury on all the other issues. Thank you.
Thanks very much. Can we then have WWF?
Thank you from our side to Treasury and for the responses. We've noted all of the responses. There was one outstanding query in our written submission that we would just like to re-raise, which is the exact warming factor for methane under the current guidance for the fugitive emissions calculation. It's set at 23, but the IPCC guidance is that it should be 29.8 for fossil methane and 27 for non-fossil. Just invite Treasury to have another look at that. Otherwise, thank you to the members and to the committee for your forbearance.
Thanks very much, James. Can we have SA Wines back?
Chair, this is Kurt Moore from SALBA. I got a WhatsApp from my colleague at SA Wine saying that he can't get back in, but in the interest of time, he'll yield the floor back to the chair. Thank you, sir.
Thanks very much. Thanks for those comments. Can I then give this opportunity to members of the committee to also make comments? I'll start with Dr. Berg, Ompile Mautwe, Lucizo Makubela, and then Wendy Alexander. Thank you.
Thank you to our acting chair. I've got a few questions on process and then some specific tax issue questions to Treasury, and then a suggestion at the end, Chair. The two questions on process is the following. Could you explain to me why it is that there seems to be this consistent pattern that SARS and National Treasury presents tax laws where, one, little impact assessment is done, and two, the turnaround time is very short, often less than a year? And then could you also explain to me why does National Treasury have a public hearing and then use Chatham House rules for that hearing? Doesn't this undermine the very intention of public hearings, which are supposed to be widely available? And shouldn't we actually be broadcasting these hearings on YouTube? Could you also explain to me why there's no new draft issued between the draft bill discussed in National Treasury's workshops versus the bill presented to Parliament on which Parliament holds public hearings? Surely it would be better to have a two-step process rather than having two public hearings for one draft bill. I'm not trying to prolong the process, I'm trying to see if we can't improve the process. Chair, my specific tax issues mostly relates to the new schools VAT issues, but first perhaps commending Treasury for having listened to inputs and having taken on board, for example, the foreign pension matter. Now, on the new schools VAT issues, I need some clarity here, Chair. The Speaker mentions that the feedback they were getting is that schools need more time to evaluate the impact. But that's not our understanding. Our understanding is that National Treasury, in fact, needs more time to assess the impact of their decision on schools. And we asked Treasury when they first presented these tax laws for studies and data on which schools would be impacted to determine how many students we are talking about. So now I have a simple question. Do you have this data yet? Can you present us with this data? Specifically on what the Speaker said today, she said there's an average apportionment ratio, which is 2%. And then she used this 2% as part of an example. My question is, can you please show us the data that comes to this average? You see, the average by itself is not that useful. We don't know, for example, does this average include instances with schools that claim a zero amount? And then we don't know how many schools lie much higher than the 2% apportionment. Isn't that right? And then, Chair, I would like to understand if I might have misunderstood something, but the Speaker mentioned that if this law isn't in place on the 1st of January 2026, then nothing stops us from auditing how schools made their calculations. So my first question is, my understanding is SARS has always been capable of auditing these calculations. Am I correct in saying that this is not something new, this auditing ability? And secondly, and perhaps a bit more concerningly, the way the speaker phrased this section sounded threatening to me. I'm sure she didn't mean for it to be so. So I just want to confirm that there isn't an implied threat that SARS will audit schools unless this law is now passed. Chair, my recommendation is that I'm sure all of our colleagues, Honourable Beasley, Alexander, Matwe, Makubela, all of them will have questions to Treasury. But with your indulgence, I want to request that we take 5 or 10 minutes at the end of those questions and deliberate amongst ourselves on what the best course of action is here. Of course, all the participants can participate in that conversation, but I would like to understand, for example, where my other colleagues from other parties stand on the school's VAT issue as it's now being proposed. Thank you, Chair. I'll leave it there.
Thank you, Dr. Burke. Ompi.
Thank you very much, Chair. Chair, let me take this opportunity to also welcome the presentations and the responses from the rest of the stakeholders. But Chair, we must begin by repeating what we've always been saying about the public hearings, even at the risk of sounding like it's a permanent rhetoric, but we have to say it. It's allowed in politics. So when you compare what Treasury presented on the 17th of September, what the public said in the hearings and what Treasury is now presenting, of course, with a few adjustments where they responded positively to some of the requests. But it's almost as if public participation is treated as an administrative inconvenience rather than a constitutional obligation. And I want Treasury to really understand that it is a constitutional obligation. It's concerning that Treasury comes to Parliament with predetermined positions and leaves no room for change, because these bills that are passed under the illusion of consultation, but in reality, they amount to information sessions, not participatory democracy. And these presentations are made deliberately complex, using very technical language that excludes the majority of our people. The truth is, this complexity is intentional. It keeps the conversation limited to a certain tax bracket, a certain race, and a certain constituency. So tax policy in practice remains an elite conversation. Would Treasury agree that part of the confusion that the public and even MPs face is not accidental, but a reflection of how insulated the institution has become? That tax policy debates are for the few, not for the many, even when the implications cut across all sectors of society. Number two, Chair, on enforcement and tax administration, and we're now forced to ask political questions because all other discussions will fall for the same issues that were raised, that they're made to be complex to exclude real conversations. So we're going to have to force the real conversations to come on board. Chair, we can't ignore the fact that we've seen reports that the former Royal Bafokeng Holding CEO, Mr. Carroll, is under investigation for 630 million tax dispute. The Pepco CEO, Leon Erasmus, in a 300 million case. There's also a matter between Flower versus SARS, where a 320 million additional assessment was overturned. Now, should we take this as isolated incidents, or are they symptoms of a deeper problem? Either poor legislative design, inconsistent enforcement, or selective application of tax laws. Does National Treasury still have confidence in SARS' ability to administer tax equitably across income groups? Because to an ordinary South African, it seems like the wealthy and politically connected can negotiate their way out of accountability, while workers face automatic pay-as-you-earn deductions with no escape route. You and I, Chair, can never escape paying for by, but there are big corporations that can evade tax. And National Treasury is just looking at SARS and not doing anything. Chair, the responses on excise duties and the health tax are extremely weak, particularly when it comes to the sugar issue. So Treasury says the inflationary increase in the health promotion levy will be cancelled. But who decided on that? Is this based on lobbying from the sugar industry? What is the Department of Health's position on this reversal? Has any assessment been conducted on the impact of the levy on health outcomes or industry employment? You take a look at alcohol and tobacco. Treasury itself admits that excise had outpaced inflation and retail prices, and that illicit trade now accounts for nearly 74% of the cigarette market. If that is the case, why persist with a policy model that clearly does not work? Chair, we look at the legislative uncertainty. Throughout the presentation, there is an acknowledgement of uncertainty, that many provisions have to be tweaked or that technical refinements are ongoing. Is this because Treasury is genuinely learning from experience, or because certain sectors, particularly finance, mining, and corporate law firms, have influence over how these laws are written? When laws are constantly rewritten to close loopholes created by private advisors, one starts to wonder, Chair, whether Treasury is still in charge or simply reacting to private sector innovation in tax avoidance. Chair, every year Treasury talks about broadening the base and reducing avoidance. Yet the reality is that the wealthiest companies and individuals aggressively avoid paying taxes. I've said that earlier on. The language Treasury uses is soft. You know, they use words like consent, monitoring, engaging. Why not call it what it is? A systemic corporate defiance of tax obligations. Is Treasury not afraid to use firmer language because it is too close to the private sector and financial institutions that are entangled, and therefore they don't want to be seen to be making the partner angry at the expense of our people? Can Treasury tell us if its tax policy unit and law administration teams are transformed in both composition and perspective to understand the socio-economic realities of inequality in South Africa? Or are these sections still dominated by technocrats who view taxation purely through a fiscal lens and not a developmental issue? Chair, does National Treasury consider its current tax policy framework progressive and redistributive? Because what we see is a structure that continues to protect wealth and burden the labor. Workers are taxed at the source. The rich hide behind trust deductions and international structures. So is there any serious plan to introduce wealth taxes, or are we still captured by the same thinking that fears the reaction of the so-called investors? Chair, in terms of employment tax incentive, Treasury proposes to adjust the formula, allowing a 60% claim on wages below 2.5. But the ETI has been in place for many years, and there is no credible evidence of job creation. In fact, Treasury itself has postponed reviews for several years. So why keep it? Are we subsidizing employers to keep cheap labor instead of creating new jobs? Are there audits or empirical studies to show that firms benefiting from the ETI actually increased employment? If not, isn't it time to end the scheme rather than prolong it? Chair, in terms of corporate income tax, is Treasury...
Can you set the time?
Yeah, I'm just left with 2 points here.
Okay.
Is Treasury confident that the corporate tax rate fairly reflects the profits being recorded, especially in the banking and retail sectors? If workers are squeezed through PAYE and VAT, while corporates continue reporting record profits, why not raise the corporate tax rate even marginally to ensure a fair contribution? So can Treasury tell this committee what proportion of total revenue is now generated by personal income tax versus corporate income tax, and whether the trend over the last 10 years reflects a just balance? Several stakeholders have raised the regressive nature of VAT, particularly given the growing cost of living. Is Treasury considering expanding the zero-rated basket or reviewing how VAT affects low-income households? And if not, What is the justification for protecting corporate margins while taxing consumption that affects the poor the most? The last question, Chair. We must ask, and it's very important, is National Treasury independent from influence of corporate investors and the financial sector? We're saying this because the pattern we see is one where Treasury consistently protects the interests of investors, even foreign ones, while failing to demonstrate courage in building a tax system rooted in justice and redistribution. How does Treasury reconcile this with its constitutional obligation to advance equality and social justice through fiscal policy? I thank you so much for your indulgence, Chair.
Thank you. Makubela.
Thank you, Chairperson, and greetings to yourself and all that are on the platform. Chair, I have only 2 questions to ask. My first question is to National Treasury. In relation to the significant existence of illegal tobacco products and the illegal factories that are in the economy, what is National Treasury and SARS together with perhaps trade and industry and the security cluster doing to ensure that they combat this existence of these illegal tobacco products? And also, what are the potential revenue losses that the country is losing in relation to this significant number of tobacco products within the market? And also perhaps maybe industry can also assist in looking at collaborating with government to ensure that these factories and these products do not find their ways into the market, so that a substantial amount of revenue can be collected on behalf of government, which is crucial for the economy and government. The next question, Honorable Chair, is perhaps maybe with regards to the potential revenue losses and the identified tax gaps in relation to the avoidance of tax. Does Treasury have perhaps means or systems to ensure that this tax avoidance, and particularly on the withdrawn matters, how is Treasury wanting to address the issues of potential revenue losses, and how is Treasury putting together systems that have been identified in the regards of the identified tax gaps, Chair? And those are my 2 questions.
Thanks, Honorable Makubela. Can we have our Beasley?
Thank you, Chair. Greeting to the colleagues and everybody on the platform. So, Chair, my comments are mainly around the excise tax, and I just implored National Treasury to hear the public participations made by those affected, and these participation has been going on for numerous years, and as Action SA, we just think it's totally counterproductive to be putting up excise tax above inflation, and it's undermining our economy, it's undermining legal trade, and all that we're doing is we're allowing the illicit market to flourish. And when the illicit market flourishes, there's absolutely no winners at all. So the call is for National Treasury to hear these voices, and let's protect the legal trade, let's protect legal jobs, let's protect investments, let's protect our economy, and stop giving gaps for the illicit market to flourish even more and doing more damage to our economy. Thank you, Chair.
Can we have, thank you, Honorable Beasley, Mekalega Mazibuko.
Thank you very much, Chair. Allow me not to show my camera due to reasons I have discussed with you. Chair, I have two questions. My first question, Chair, is that having observed that the Urban Development Zone tax incentive is now being extended by 5 years, with a new sunset date set for 31st March 2030, what is the total investment attracted within the incentive development zone? And my second question, Chair, would be on the cross-border tax treatment of retirement fund benefits, so that foreign retirement benefits received by SA tax residents are taxed, ensuring consistency with double tax treaties and the residence-based system. How is the department then enabling an alignment of our tax jurisdiction rights and those of foreign countries where our compatriots work? So those are my two questions, Chair, and thank you very much for the presentation and also the inputs from the stakeholders. Thank you.
Thank you, my colleague Mazibuko. Can we then afford once again National Treasury and...
Please don't forget me.
Oh, Ms. Wendy, I'm so sorry. And you were supposed to come after Makubela. I'm so sorry. Yeah, you have the platform.
Thank you very much. Two simple questions. My one question is around the VAT being charged on imports into South Africa on all goods, and like to protect the local economy from potentially cheaper imports that would be charged. My understanding, if I was hearing it correctly, that recommendation will be set aside because SARS isn't ready. The system isn't ready to do that. So my question to Treasury and to SARS is, we should be protecting our local business, and the computer system or whatever system it is in place to charge that on imports, when will that be in place? Because it doesn't seem that that's a really good argument that we won't be taking this recommendation based on a system. I'd like to find out from Treasury and SARS, when will the system be in place so we can protect our local economies? And then, Chair, I'd just like some clarity around excise tax, and just to understand at what point excise duties are levied on the industry, and is it the same within the beer industry and the spirit industry? So the question is, at what stage in the production are excise taxes applied to beer manufacturers? And in the same breath, what stage of the production is excise tax applied to spirit manufacturers? And then if they are at different stages, is there a material difference in the timing or the processing of this excise tax between the two industries? Thanks.
Thanks, Ms. Alexander. Can we then have both the National Treasury and SARS to follow? Thank you.
Thank you very much, Honourable Chairs, Honourable Members. Thanks for the comments from the stakeholders as well. There's quite a lot there, so I'll see how far I can go, and I will also ask my team to come in on any of the issues that I haven't covered. So to start, there were quite a few comments from Heineken, SAB, Selba on illicit trade for alcohol. We completely agree with those points. We also want to try and reduce illicit trade as far as possible. The more we can reduce illicit trade, the greater revenue we can get, the lower the risk is of unregulated products getting into the market. So it's important for us. We provided additional funds to SARS in the last budget. We are hoping that part of those additional funds will be used to tackle illicit tobacco and alcohol, and we have been having discussions with SARS on those issues. We note the point about the difference between our excise duty changes on tobacco and alcohol, and we will think about that. In terms of the long-term tax certainty, that is why we're having that discussion paper that we released, as well as the workshops that we will start with on the 6th of November in terms of looking at the excise policy for alcohol. The issue, the minister does have discretion though in all of these environments. So the minister can make amendments that slightly deviate from policy. It's not a legislative framework, it's just a guidance. We can show the data that shows in previous year when there was above inflation increases, there wasn't a fully above inflation increase in the average price of these products, which is why the excise burden then increases over time. To show that there hasn't been full pass-through, that's part of those discussions that we'll have in that workshop. On the consultation process, I note that point from Psych, I'll come back because Honourable Burke also asked it. And again, also that point about the different legislation. So the points on the 20 cap A on moving down to 39%, I think we note that these taxpayers earn over 630,000 Rand a year. So it's a subjective point about should we be supporting those middle income taxpayers. If you look at 630,000 Rand, it is quite a lot. Our approach at the moment is to keep that amendment so that it does go down towards those that have a 39% marginal tax rate. There are other welcomes on some of the issues, the capital distributions. There might be some technical points that the others can come in on, especially on the WWF. Okay, the process about, there's points about the process and what we do. So in general, and for many, many years, the process has been that we have these discussions, then we listen to the comments made by the members, then we go away and try and finalize the bills that then go and are tabled at the NTBPS. We haven't had this additional chance between this hearing and NTBPS to have another round of consultation. Our approach has been that we don't try to make any large tax changes in this round. So we either withdraw or make very small refinements to the legislation before it gets tabled in the NTBPS. If we were going to make a very large change, as we mentioned on the cross-border pensions, we needed to work on a couple of additional issues. We didn't want to put those big amendments into this bill that is suddenly getting tabled and then legislated, which is why we then take it back and we will try something new in a new year. So the amendments generally are much smaller than the initial proposals. The initial proposals from the whole year, we've had an announcement in the budget. Then we put the draft legislation with those big changes, and we do have that long consultation period between the draft legislation and now to try and get the comments of the public and institutions involved. On the Chatham House rules for the public consultations, I think it's a good point, and we've been having that debate internally as well. Previously the view has always been that we worry that commentators won't then say what they really mean, or they worry to actually speak up in these sessions if it will all be public. But I think it's a reasonable point. These are discussions that we're having about determining tax policy, and they could be made public, which is why we also had that disclaimer in our consultation documents this year to say that if you do make a submission to us on these public comments on the draft bills, we can make those public. So we are trying to move that way. On the schools and the VAT issue, this is a proposal where the schools came to SARS and Treasury asking for it. They were asking for us to try and reduce the administrative complexity of dealing with the VAT system and to be taken out of the VAT system. So as Treasury, as a policymaker, we don't have sight of the individual tax affairs of the schools. That's private information, and SARS can't share the private information with us, that confidential information. So we do get some aggregated statistics from SARS, but we can't point to particular individuals. Part of the reason we have the consultation process is to say that if those taxpayers want to come to us with their particular issues, they then can. From what we've seen on the schools issue, it looks as if some of the schools were claiming VAT refunds far in excess of what they should have been, which means that they could get audited. And as you say, Honourable Burke, SARS could have audited at any time. So this isn't saying that they can now audit after a point. They could have audited up to now already. I don't think what Anissa was saying was trying to be threatening, but it was trying to say that, if this amendment goes through, then we are closing those assessments so that they won't be audited for those previous tax years. Whereas if it's taken away and SARS realize from some of the public submissions that are made by some of the schools that those schools claimed too much in terms of VAT refunds, and they would have to pay back much larger amounts because they would have to pay back the full VAT recoupment as well as interest and penalties. So it was a potential way out for schools that might have been non-compliant. We certainly don't treat public participation as an obligation. Public participation is incredibly useful for us. A lot of these issues are very complicated, and we don't have the exact skills that an individual in a particular sector might have, or the nuances of the issues. So the public participation is hugely important for us to do those refinements, to understand the process. But in no ways are they telling us what to do. We look at all these proposals that come to us in an objective manner. We work with SARS in an objective manner to say, does this make sense? And then we either change or we do not change. Some taxpayers might want to put forward something that is not in the public interest, and we will say no. And they might be upset and they might come to the committee and complain about it, but we will hold our line. We are certainly not trying to make this, the complexity intentional. Unfortunately, a lot of the tax legislation is very difficult, but it's part of our job to try and explain it simply and clearly, and we will keep trying to do that to make it open and accessible for everybody. So the tax policy debate should not be for the few. We have full faith in SARS that they need to carry out their mandate without fear or favor. They must audit all individuals, all corporations fairly, and we trust them to do so. And we have provided additional funding for them to fulfill that mandate. On the excise duties, on the health promotion levy, this has been a discussion between both, health, the Department of Trade, Industry and Corporation, and ourselves. There is a sector that the DTIC are trying to support through the Sugar Master Plan, and those are the objectives and the balancing acts that we need to make as a Treasury and the Minister needs to make, in terms of how do we try to achieve one objective while not undermining the other. In terms of assessments that are made on the HPL, there have been some reports to show that there has been a reduction in sugar sweetened beverage intake, especially in lower income households. It hasn't yet flowed through to health issues, whereas some on the business side have put forward reports on potential economic impacts of the health promotion levy. So we do try and close as many loopholes as we can, and that's part of what we do every year in this process. The tax system we think is progressive and it is developmental. We have one of the highest and most progressive personal income tax schedules in the world. When we did this cross-border pensions issue, for example, if you suddenly are a tax resident in a developed country and you come here, and we were trying to do the calculations, you actually pay more here in many of the cases because our personal income tax system is so progressive. The developmental aspect, all of that money goes through social expenditure through the budget. The employment tax incentive, we've done a lot of reviews. We put this to committees in previous sessions. I think there are about 10 to 15 different papers that have been written on the impacts of the employment tax incentive. Some of them say that jobs were created. Some of them say that jobs weren't created. And I think the last one says that we can't actually tell. So there has been mixed evidence on those reviews. We extended it by 10 years on the basis of this committee's recommendation after a NEDLAC review. Are we confident that the CIT rate is correct? If you look at other African countries, they have much lower corporate income tax rate headline rates. Mauritius is at 15%, Botswana is at 22%, I think Egypt's at 23%. Part of that is to try and attract investment, to try and attract growth and employment. We make sure that we close all the potential loopholes so that all corporations do pay the tax. If you can see, our global minimum tax has been introduced last year. We are part of that OECD intervention. We are expecting that will bring in an additional 8 billion this year, as multinationals are meant to pay their tax, so that they pay that top up so that that minimum is at least achieved. And we will continue to use sections like 23M, which limits the interest deductions, to make sure that base erosion and profit shifting does not take place. On the zero rating, we did pull the zero rating this year after the VAT rate increase was withdrawn. We think the zero rating is very well targeted. If you start extending it further, you start giving high income individuals a big benefit, and there is a large revenue loss associated with that. And because of that revenue loss, we then aren't able to have as much expenditure on health or education. So you start giving a benefit to middle and high income households when you expand the zero rating base beyond those that are targeted to low income households. In terms of combating illicit products, we're working with SARS to do that. We are hoping that they can make progress with this additional expenditure. On the tax gaps, that's part of the SARS annual performance plan, is to try and reduce tax gaps, where they have worked with the IMF on the VAT gap, they've worked on the corporate income tax gap to see how much tax is actually left out there, and they will start tracking those amounts and trying to reduce them over time. On excise duties, we note the points about trying to be counterproductive if the duties go above inflation, and we're looking at all those comments. The minister will make another determination in the budget. We can get back on the UDZ investment amount. We have done a previous review, so we do know those figures, but I don't have them offhand. On aligning with other countries on the foreign pensions, we've withdrawn now, but that's why in our comments today, we need to go back and look at these issues. That is still a pending problem in our view. We need to try and reduce double non-taxation as well as enforce our taxing right. I think SARS could potentially answer on the VAT system, and I don't know if Umpo can come in on the excise duties on beer and spirits. Colleagues, would someone else like to then come in on any of the other points that I have missed, as well as France for SARS and Umpo on that excise duties?
Thanks, Chris. I think maybe just one point on the excise duties. I mean, the current system that we apply to the question by Honorable Wendy is that the excise, we apply what is called duty at source, meaning that the excise is applied at the factory gate or at a point of importation. So it is at the upstream in terms of the value chain. So at the factory level, the excise duties are applied. I think maybe that's just maybe one point that I wanted to highlight, or maybe just the other thing is just to say that some of the issues that have been raised around illicit trade on alcoholic beverages will be starting with the consultation process, and we'll have a focused workshop on illicit trade, that we can look at some of the nuances around some of the issues there, considering some of the differences in terms of the products involved with regards to illicit trade. Thanks.
Thanks, Anita.
Thanks, Chris. Yes, just to add to what you were saying about the schools issue, yes, of course, it can never be a threat, because we don't have the power to audit, and we've been trying to help the schools as much as possible. But just to point out on that one, that it's just in the normal course of SARS work that audits are inevitable, especially now that the spotlight has been shown on this issue. So we're trying to protect them by implementing this and implementing the section that will protect them from audits of if anything was done incorrect in the past. The other thing to mention is just that with schools, we did, like you had mentioned, we didn't come up with this proposal from our side. It wasn't something that we said we're going to do this out of the blue. Schools, governing bodies approached SARS and approached us, and we do have a list of all of that. I mean, we've got associations serving independent schools such as ISASA that predominantly represents most of the independent schools. Then we've got the public schools as well. We've got a list of the different governing bodies that were at the meeting and that had requested this. So it was basically, at that point, they said to us there were about, I think, 3% of their members that did not want us to implement this, that wanted to stay on the register. But after they had further discussions with them, even those came back and said, no, they see the wisdom in it. So it was something that we are trying to assist with.
The other thing that I want to mention is when it comes to the low value goods, just to highlight that VAT is already being levied on the importation of goods. This amendment is only going to deal with a small portion of goods where customs duties are not being levied. On those ones, so that's below the 500 and below the 100, but it can be below 500 and below 100, and customs duty is being applied on that. Then in that case, it will still be subject to VAT. So it's a very small amount of of goods. Well, the volume is great, obviously, but it's a very small portion of all the goods that are coming in that we are considering the amendment now. And because it's such a unique subset, the systems will take time to be programmed to deal with this unique subset, which is not going to be quite a simple task on that. That's so. Like I said, we do have data on where we dealt with, and as far as the system's readiness is concerned, I'm not sure if SARS, France want to comment on that, but like we said, it's not a simple fix. Thank you.
Thanks, Anita. France, do you want to comment?
Great. Thank you. So I think Anita's already covered it. It was from the 1st of September last year that VAT on imported goods below the threshold started being imposed by SARS. And in fact, that feeds through to another set of amendments that did not give rise to a good deal of public comment, and so are not in the presentation today, but are in fact in the detailed response document. And that is the simplified entry regime for goods imported or exported for purposes of express delivery. So the thinking here is that we impose the additional taxes and duties, but that means a lot of small parcels now need to be dealt with in terms of the customs system. So we need a simplified mechanism to deal with that. And that is one of the legislative interventions that is in fact in this bill. Just to run through a couple of other issues, there was the point being made that the 1 million rand in the substantial understatement penalty hasn't been adjusted for a while. So just bear in mind that that is the greater of 1 million rand or 5% of the tax properly due. So we're talking about somebody who has 1 million rand of tax at issue. So these are not small players, even at the 1 million rand. And as you grow, the 5% rule starts coming into play. So that is an automatically adjusting rule when we work with the 5%, and it is the greater of the two. So there are two legs to this, and one automatically adjusts. I take note of the points that were made around restriction to courts. We believe these are reasonable restrictions. And as I say, they are welcomed because they ensure that we deal with matters before both sides incur substantial expenses, which could be avoided had both parties been able to engage before the court application was lodged. There was a comment around buy to rent. I step slightly into the policy space here. One of the difficulties with buy to rent, of course, is that when the property is ultimately sold, it's subject to capital gains tax. So if you are permitting the tax deductions for the losses incurred over an extensive period of time, but the proceeds at the end are taxed as capital gains, the tax system and the fisc get the worst of both worlds because the deductions were all at normal tax rates, but the income comes in at capital gains rates. So the ring fencing merely says that what needs to happen is the losses are offset against other rental gains. So if you're in a scenario where you start off with losses, but later you make profits, the losses are available for you to use, which I think is an important point. On the question of our system and the 80 days, thanks to the commentator there, I think that demonstrates the point. The application was accepted and then it was revoked. And that is precisely the issue we're speaking to here. We have detected that there is an edge case that comes into play there, and we're trying to address that. And then finally, on the reasonable care not taken, thanks for being willing to wait and see how we've tried to adapt to that. But I think the case law is pretty clear here, and if SARS auditors step outside of the case law, they obviously should be reversed in pretty good order as it enters into the review mechanism. I'm just trying to see if there's anything else. On tax gaps, I think Chris has already dealt with this, but this has been the subject of several interventions by the Commissioner in interactions with the committee. And I believe he's dealt with that with a great deal of detail. So I would hesitate to try and repeat what he's had to say there. And I think that is it from my side. Thanks.
Thank you, Chair. I think that covers everything from Treasury and SARS.
Thank you, SARS and National Treasury and SARS. And the stakeholders who were able to make it for the meeting, but also who have made the contributions. There is a matter that has been raised by Dr. Park on the school taxation, which he suggested that we should at least have 10 minutes on the issue as a committee. Now, I'm not sure if Dr. Beck will agree, but we have, I actually consulted with Alan on the matter, how it was dealt with previously, and apparently there is a legal report that was, or opinion that was actually put together for the committee, which we have been trying to get hold of so that we can be in a better position to deal with the matter. But as well, we thought it might need a little bit more time so that we could then, on those bases that we are able to retrieve the legal opinion, we then take the matter to the committee so that we have ample time to actually look at the matter, if that's acceptable to committee members.
Chair, if you'll allow me, I think that's completely fine. I would also say that some of the points raised by Treasury now are compelling, and if we can just get what was presented verbally now in writing, for example, the 97% of public schools that were in favor of this and the 3% that came around, if we can get that in writing, then we can take that under consideration. So we're also very open to that. Thank you, Chair.
Okay, thanks a lot, Dr. Berg. And on those bases, let me therefore thank each one of you individually and collectively for making this meeting a success. And National Treasury will then be able to provide the committee with those written submissions so that we're able to look at that. And that will be able to help the committee to make a valuable contribution towards that. And once again, to stakeholders, thank you very much for your time and for the comments, but also the overall contributions that have been made. Let us continue to work together so that we can make sure that we build a better country, but also we are able to make sure that each and every individual, every citizen, every stakeholder in this country has got a contribution to make, and we are able to create that space for that, for citizens to be heard. And once again, thank you for everyone, and the meeting is adjourned.
Thank you, Chair. Thank you, honourable members.
Thank you, Chair.
Long live the Chair.
Thank you, Chair.